Hello and welcome to the 2024 Election Trading Playbook presented by TrendSpider. My name is Jason Krutzky. It is a pleasure to be with you all today. Thank you for tuning in. Let's get right into the presentations. Joining us first today is Mr. Ryan Detrick from Carson Group. Ryan, take it away.
All right. Well, thank you everyone for being here. This is going to be a lot of fun. This is an awesome event, TrendSpider. I'm so honored that you invited me. Right. I talk about a lot of stuff. We'll see how this goes the next 35, 40 minutes. Hopefully the listeners and viewers get something out of it. But I'll say this much, the guests we have, the TrendSpider has so far have been awesome. I know some more are coming. I can't wait to watch some of the replays of all the different guests. I know this has been a great event, and it's really important, right? Because you think about what's going on. We're in a bull market. The economy is doing well, but oh my goodness, here's this recession coming. Recession, wrong word. Election. I don't know if that was a Freudian slip. There's no recession coming. I'll talk about that. There's an election coming. What does it mean? And I've got as usual, probably people follow me on social media. I've got a lot of charts and a lot of things we're going to dive into here. So we're just going to get into it. Kind of called this one Managing Your Wealth Insanity in an Election Year, because I think that's a big part of it. I'm Ryan Detrick, Chief Market Strategist with Carson Group. What in the world's Carson Group? We are an RIA with approximately $38 billion, almost 500 financial advisors in 42 different states all around the United States. And I've been with the team over 2 years now. My job's a lot of fun as a market strategist. I get to talk about stuff like this, right? I get to travel the country, talk with our financial advisors, talk to their clients. I work on a 16-person research team that manages billions of dollars. One of the cool things that I'm going to talk about today, and anytime you see me out in the media, what I'm talking about, it impacts, right? What our team is up to, what we're seeing. It's not like all my opinions go into everything. We have a team approach. I want to be clear. But when I'm speaking, it's what our team sees. It's how we are investing real money for clients out there every single day. And it's something I like we have a lot of fun with, but something we do not take lightly. So let's just get into it. Keep your eyes on the prize. This is an oldie but a goodie. I'm sure a few people have probably seen this circling around the internet. You always have a plan, right? You got this plan, like here's my long-term investment goals. Oh, great. I'm going to wait a couple decades. It'll be nice and easy. That's the top, right? Well, the bottom's reality where, we've just had, just in the last 4.5, 5 years, we've had two different bear markets, right? If you're a long-term investor, really, you shouldn't be too worried about bear markets. Honest to goodness, they're part of the process. They've happened before. They're going to happen again. But the reality is someone who gets to work every single day with financial advisors and specifically their clients, we know emotions matter. I'm wearing my shirt here. Facts versus feelings. It's my podcast. It's important to look at the facts, but feelings clearly matter as well. We'd rather focus with facts, but we are aware that feelings matter also. And I make the joke, this summer when the Salesforce thing all went down, I was traveling Delta. I was supposed to go to Minneapolis, which is a Delta hub. I thought it'd be like on the top, but getting to Minnesota was anything but. I got home like at 2 a.m. because my flight didn't leave on Delta. And then I took a 6 a.m. Frontier flight. Now, listen, think what you want about Frontier. I got like 90 minutes of sleep, took an Uber back to the airport, made it. But my trip to Minnesota this weekend was the reality, and it was anything but smooth. And that is investing in general. Now, listen. There's lots of news, and I know I'm here to talk about the election, but I'm doing a big picture view here for a little bit, and then we're definitely going to dive into the election, how we see, the kind of things shaking out. But again, just look at the news lately, right? We just had some terrible news lately, yet stocks are literally, at least as of the end of September, having their best start to an election year ever in history, up well over 20%, right? The first 9 months of the year. We'll see what happens in October, and obviously election coming up. We'll talk about that stuff, but there's lots of bad things. You've all seen charts like this. This is what we made. Just a lot of negative things have happened since May 26th, 1896, when the Dow started trading. The good news, there's been a lot of good things that have also happened. They say the stock market's the only place that things go on sale, yet everyone runs out of the store screaming. Right. And you think about, you want to buy some shoes. If they're on sale, well, maybe you buy your shoes. Maybe you got that favorite stock out there. I can't really talk too much individual equities, but there's some stock you like out there. It's down 15, 20%. You probably loved it when it was up 15, 20, then it's down. And you kind of have to rewire your brains. It's not our fault. It's how our brains are wired from caveman days. When something bad happens, we follow the crowd and we run the other way. When it comes to investing, listen, I'm not saying always be a contrarian just to be a contrarian, but we do have to rewire our brains to a degree, and kind of remember that throughout history, bad things have happened, bear markets have happened, but to use those likely as opportunities to reach our long-term investment goals. And that's why you get to this election we're going to talk about. Lots of fear, lots of this, lots of that. What could it mean? The last couple elections, we saw sell-offs ahead of the election, but then rallies after. We'll get into it, but those are really important things. Now, Will Rogers said, "I don't make jokes. I watch the government and report the facts." I like that. I've got some other funny election government quotes coming up here. So what could happen? Listen, I could talk an hour on this. I don't want to. I don't need to. You can take a picture with your phone right now. I'm sure we're going to share that. We can share this deck later with people if you need to. It was something our team created at the start of the year. Carson Investor Research Team put this together kind of if President Biden were to win. And I get it. President Biden didn't win. That's why we did a fun little scratch his name out and put Harris in there. President Trump wins and you break things down. I mean, the reality is, yes, the Trump tax cuts, kind of hard to say. The Trump tax cuts are right there. Who wins, of course, matters, but the breakdown in Congress is going to matter as well. Obviously, corporate taxes. I mean, if President Trump wins, hey, maybe you get a cut in taxes or you keep it there. Obviously, if Vice President Harris wins, that's going to swing things a little bit away. She's already said she wants to increase taxes, right? That shouldn't be anything new, shouldn't be a big surprise. But then how does Congress come out matters. And then tariffs is the one that it feels like, that's there also. Clearly, Trump would probably want to increase tariffs or still be very tough on China, different parts of the world. Now, the thing that's unique about everything the last 4 years, President Biden has not really removed any of the tariffs that President Trump put on China starting way back in 2018. We have a divided Washington. One of the places we're kind of unified apparently is being tough on China. So those are some things we're watching there. Now, what's not going to change, I'll get more into this at the end, defense spending, discretionary spending, having deficits. It's just kind of how big these things are going to be. I don't think it matters who wins, which side, and even how Congress is made up. Those are the kind of things we know on the other side that are probably going to stay the same. It just depends on how big these changes are. Now, this is a really cool chart from PIMCO. Big fan of PIMCO. They do awesome work. Again, you can kind of look at this is again PIMCO's opinion, but I kind of follow what they're up to over there. Libby Cantrell put this together, and we've done a lot with Libby over the years. So when she speaks, I like to listen. Again, these are some breakdowns and things. You can take a look at this, later, and dive into potential breakdowns. But again, it's all about taxes. It's all about the deficits. The tariffs. Those are the things that matter. And to be very blunt, to be very honest, we aren't going to know how it all shakes out until well after the election. And now here's where I want to go with this. It isn't easy. Don't you love AI? I said, give me a picture of the last three presidents all sitting back, drinking a beer, having fun together. I don't know if that is reality. In fact, it's probably not. That all probably be hitting each other right there or something, but they're having fun right now. So it is possible. But you think about it, a lot of people didn't like President Obama. Stocks did amazing. A lot of people didn't like President Trump. Stocks did amazing. A lot of people didn't like President Biden. First 2 years, yeah, not too great. Boy, oh boy, the last 2 years done really, really well. And let's not forget, when President Trump won, the talk, energy is going to do great. Green energy is going to do horribly. Oh, he hates Jeff Bezos. Tech's going to do terrible. Like all the opposite stuff happened. Coal. Oh, he's going to be great for coal. Coal did very poorly because it's all about kind of regulations and supply and demand. And if you regulate things, well, sometimes, if demand is still there or supply is kind of going down, what's going to happen to the price, right? So it's not as simple as you think. And then with President Biden, when he won, well, green energy is going to do great. Dirty old coal is going to do terribly. Dirty old crude is going to do horribly. What's the strongest group? Like energy. Energy's been the strongest one, right? And coal, literally, they took KOL. Remember that ETF? They killed that ETF because there's no need to have coals. All the coal companies out of business. Well, the few coal companies that are around been like the strongest possible thing you could have bought under President Biden. So I'm not minimizing kind of, how things will shake out after the fact because policy clearly matters. But I will say we'd be somewhat skeptical if someone tells you, well, if so-and-so wins, this has to happen because it usually isn't so clean and so clear cut is what I want to say. Mark Twain told us if voting made any difference, they wouldn't let us do it. That's another good one there. So big picture stuff. People like me for some of these things. So we'll get into this in a minute and then talk election along the way. The bull market turns 2 On the 12th, October 12th, the bull market turned to, right? October 12th, 22, the end of a 25% bear market, vicious bear market. If you followed me at all, Carson Group, we were on record around the second week of November 22 saying that was it. The lows were in. To say that that was hated, to say that that triggered people would be an understatement. The majority of 2023, we were bullish, saying there's no recession, saying stocks are going to do really well. It wasn't a very popular call. But here's another one that's not very popular, but I'm just going to do it anyway. This bull market's 2 years old now. Gained about 60% the first 2 years. Your average bull market, okay, and by the way, remember there's this joke about a statistician put his head in a bucket of ice, feet in the oven. They said, how do you feel? He goes, well, on average, I feel pretty good. They get worse. Sorry. But nonetheless, I don't know where I was going with this. Oh, averages. So the average bull market, as you can see here, is last like 5 years. This one's only 2. All right. Average bull market gains 180%. Now, listen, that is skewed by, you can see there, what was it? The almost 600% rally from 87 to 2000. But the median still over 100%. So yes, this has been an incredible move the last 2 years because stocks have gained like 20% 2 years. But don't forget, the S&P went like 2 years without a single new high, 2 full years of going nowhere. So now we've got this 2 years of good moves. So it's all about, listen, we had a lot of pain. 22 was not very fun. 22 was like one of the worst years for stocks we've seen in a long time, but it was like the worst year in the history of bonds. Okay. Ned Davis research says the worst year for bonds since George Washington was president. I don't know how they came up with that number, but if you have a diversified portfolio in 22, stocks did terribly. Bonds did not give you the zig when stocks usually zag. The last 5 times stocks lost 20% for the year, bonds are up double digits every time. That was not the case in 22. So anyway, and then just interesting stuff. But what's the word I'm looking for? Bull markets tend to start in October. Midterm years of a bull market, midterm years of election years, midterm years 22, tend to bottom in October. These are things we talked about repeatedly. People didn't believe it was possible, I guess, because of the yield curve, apparently. But there's a lot of other data you can look at, and we've been sharing it. The reality, though, this bull market is young, so happy birthday to the bull and keep going. Some quick ones. We'll just hit on these. What did we know coming into this year? So again, I'm a market strategist. I look at everything through the lens of what's the market doing. I have a CMT, right? I'm a disciple of John Murphy, stockcharts.com. The message of the market, and some other great speakers you've had on, they're going to be on today and different times. They maybe really dig into the weeds of policy and things like that. I'm all about like, what's the market telling us? Okay, we can talk about the election, talk about the economy, talk about the F word. I hope I'm allowed to use the F word. I think it's not going to offend too many people. The Fed, that's another word that triggers people anymore. But the reality again is, what did we know? Which one do I have here? Okay, good. The last 10 times did a president up for re-election, and I get it. This has a big asterisk on it now because President Biden did not choose to run again. But the reality is, coming into this year, when you have a president up for re-election, the S&P has been higher the last 10 times, up, what is it, 12.2%? Yeah, up 12.2% on average. It's just one stat, one data point, one thing. Don't always, people, I share stuff on Twitter and X, and people get fired up. It's like, this is just one tweet. All right, I don't invest anything. Our team doesn't invest anything in just one data point. We look at hundreds, thousands of data points and combine them all to come up with our overall macro and investment thesis. But knowing this coming into this year, hey, things usually pretty good when you have a president up for re-election. What do we also know? When you have a red midterm year, you almost should root for a red midterm year, apparently. I mean, so let's see my math right. 25, so that'd be 26. 26, honestly, maybe stocks go down again. We've been bullish. We think stocks will do pretty well next year, too. We're putting the finishing touches. We're not finishing touches. We're kind of starting working on our outlook. We think stocks are going to do pretty good again next year. But once you get to the midterm year, things maybe can be a little upset. And when you have a red midterm year, as you see here, the next year, the pre-election year, has never been lower, but the election year has never been lower. And again, these are things we knew coming into this year. The things we talked about all the time to put the groundwork in. Yeah, elections are scary and they're uncertainty, and a lot of people are going to get mad, a lot of people are going to get upset. But from an investments point of view, as a market strategist, these are things we need to focus on, that things tend to do pretty well. Also, when you gain 20% in a midterm, in a pre-election year, like we did last year, the election year, never been lower. Yeah, it's not like, do we have any 20% gains there? Yeah, there's one. I guess there's one in the mid-90s. But the reality is, again, it's unlikely to have back-to-back 20% gains. We've been on record all year saying, listen, it could happen this time. And, I'm going to talk about the economy briefly, but the reality is that we continue. We've had 3% GDP last quarter, maybe 3% this quarter. We've had strong productivity in our country, like the strongest productivity we've seen in our country since the mid to late 90s. Periods of extended productivity, like we're seeing now, first time in 30 years. You know what happens? The economy tends to surprise to the upside. Sono Varghese, I do this Facts versus Feelings podcast with him. Great guy. He's been on this view that we're going to have a lot better productivity. He's been talking about this for like 18 months now. We've been having strong productivity for like 3 or 4 quarters in a row, maybe even 5 quarters. We've been having it for an extended period of time. When you have better productivity, the economy does better than people expect. That's just how it is. With strong productivity, that's this thing that's going to continue to push the economy higher. We don't see a recession. You put all that together with the fact that it's election year, with the president up for re-election, with a 20% gain last year, with a negative midterm year, to be up a lot right now should not be a surprise at all, honestly. If you look at these things, pre-election years, it is what it is. Normally are pretty strong. And then check out election years, higher 5 out of 6 times, give or take, approximately 83% of time. So right around there. But we had huge drops in 2000, huge drops in 2008. It is what it is. Also Republican presidents, by the way, totally random, but the tech bubble burst and obviously GFC. That's why that average return isn't that good. But all in all, election years usually are pretty good, which surprises people. We'll get into kind of when most of the gains happen here very soon, but just some things to think about or to have already thought about, to be honest. Churchill said the best argument against democracy is a 5-minute conversation with the average voter. I think that's 5 minutes might be a little long, but anyway. When do those gains tend to happen? It's later in the year, right? October in an election year is actually negative. It's the worst month out of the 12 in an election year. So just something to think about here in October. We'll see if we get some of that volatility, October surprise, October jitters. But November and December historically are really strong. Now, listen, this election year's the way the markets behave been unlike anything we've ever seen. Like I mentioned, it's like the strongest election year we've ever seen. Normally the first half of the year isn't all that great. So listen, it's a guide, right? Looking at seasonality and some of these look, history doesn't repeat itself. It often rhymes. Mark Twain, I like to use that. These are guides that we're looking for. I mean, Jeffrey saw it. I'm probably someone said it before Jeff, but Jeff says, listen, in bull markets, surprises happen to the upside. Okay, we are in a bull market. We've been in a bull market for a while. We've got an economy that continues to surprise, a consumer that's still pretty healthy, corporate profits at all-time highs. Our valuations stretched a little bit. Yeah, they are stretched a little bit. Doesn't mean they can't continue with profits continue to improve to the upside. So you stack all this on top of each other. And yeah, I mean, we've had surprise the upside, but election years tend to have a late year rally. I don't think this year's going to be different. I wouldn't be shocked at all. We had some pre-election jitters here as we get closer to the election, maybe even after the election a little bit as we kind of side through what it all means. But then we'll get likely that upward bias into the end of the year. And here's just another way of showing this year. Again, this year's up like over 20% or so, at least as of the end of September into early October. And here we are again. This is a really, really good year versus what your average election year looks like. Fourth quarter's best quarter of the year. Again, kind of talked about this already, but just overall, higher close to 80% of the time. It's higher a little bit more when you're in an election year. Sorry. So I'm looking at all fourth quarters up over 80% of the time. Up, what is that? 4.3% average. And just something to think about. Again, it actually is a little bit better in election years like we are, but something also when you are up 8 of the first 9 months, it's bottom right there. What happens in the fourth quarter? Things get better. Market's been never lower in the fourth quarter, and even better return. So a good, strong start to a year, like we've seen historically strong start. You actually might get more upside. Now, is that because it's a lot of institutional investors are chasing because they're behind? That's the most logical argument. I think that really could be true. I mean, we do this. I mean, we talk to people all the time. So many people have missed a big chunk of this bull market. And once you get through that election, I think we could again see another chase. Churchill again, Americans will always do the right thing after they've tried everything else. That's another interesting one. So talk about this, just to make it quick. On the left, forward S&P 500 earnings at an all-time high. All right. I mean, it's up over like 267, 268. Yeah, that's forward earnings. It could change. Here's my argument there. It could also change to be a little bit stronger. That's what we've been seeing for like a year and a half now. All right. Forward earnings to start of 23 were like 225. Now we're pushing almost 270. That's why stocks are at all-time highs right now. Nothing to do with the Fed, nothing to do with the election, nothing to do with Congress. It's because corporate America continues to be agile, continues to improve. I don't have the chart, but profit margins are actually going higher also along with profits. That's a dual tailwind. Now, I can spend all day on this. I'm not going to. On the right, we hear it's a bubble, it's a bubble, it's a bubble. Yeah, some years you tend to see, let me make sure I'm reading this right. Yeah, some years you see multiple growth, right? Some years you see earnings growth. But what Sony put this together on the right, we got like 92% gain the last, what do we go to here? Since 2020. Okay, since 2020, S&P's almost doubled, all right? But a huge majority of those gains came from earnings and dividends. Yes, a little bit came from multiple expansion. That's okay. You see that in bull markets. But I think it's just really important people to remember earnings are continuing to increase. And that's why, again, what happens with taxes, what happens with corporate taxes, a lot of that stuff is potentially going to matter, right? And we'll talk a little more about it, but those are just big picture things to be aware of. We can skip that one. It's kind of the same thing. We don't see a recession. I'm going to be sounding like a broken record. This is some proprietary data that we have. We have our own leading economic indicators with different inputs. Listen, the LEI, the conference board puts together, has been saying there's a recession for the past 22 months, 23 months, something like that. Ours is not. Okay, ours still does not see a potential recession. We continue to think inflation is last year's problem. We've got a Fed that's now cutting, by the way. When the Fed cuts, there's no recession. What happens? Well, usually stocks have been higher a year later every single time. When the Fed cuts within 2% of an all-time high, like they just did last month, give or take a month ago or so, within 2% all-time high, a year later, S&P's higher. Ready for this? 20 out of 20 times, up almost 14% on average. So you've got inflation coming back. You've got still a pretty solid consumer. You've got corporations growing, hiring slowing down. Yes, but this is that part of the cycle where hiring will slow down a little bit. But again, the majority of the data that we look at, yeah, there's some cracks. You say housing, a little bit of weakness, small business investment. We'd prefer that to come back a little bit. We think why rate cuts really could help those two areas. But all in all, we simply don't see a recession. This makes people angry also, but households are in some of the best shape they've ever been in. Okay. I know there's record credit card debt and there's record debt. That's denominator blindness. People do not talk about the record equities that we have. I hope a lot of listeners out there have a house or two, own some equities the last 15, 20 years. How you doing, right? You're probably literally sitting here worth more than you've ever been worth in your entire life, the time we're talking right now. And that is something that's really important. On the left, we're showing incomes and wages are growing faster than inflation. Yeah, inflation was higher than anybody wanted, but something people didn't talk about in 23 and parts of 22, mainly 23. Wage growth and compensation was growing faster than inflation was. Inflation is still high, but it's still growing faster. Now inflation's coming back. Wages are still staying strong. On the right, I've got corporate balance sheets. All right. What's a balance sheet? Well, equities, liabilities. So we took a look at that, and when we had to normalize it though, because these numbers, you have to normalize these numbers. We did it by what? Disposable income. So we looked at balance sheets and normalized by disposable income. That's on the right. All you need to know, that's the highest it's been in like 25 years. People are in some of the best balance sheet their balance sheets are in some of the best shape it's been in 25 years. Doesn't mean you can't have an economic slowdown. Doesn't mean we can't have a recession someday. But with consumers still that strong, we're optimistic there's no recession coming. We're going to get into election stuff real soon. George Washington was the only president who didn't blame the previous administration. Source unknown. So here's a big question. Who's better for stocks? Republicans or Democrats? Now, before I go there, just know I'm going to give an answer. If you don't like it, just wait a minute, because I'll give another answer you'll like, and vice versa. If you get mad you like the first answer, you're not going to like the second answer. Historically, stocks have done better under Democratic presidents. There have been more Democratic presidents going back in history, and Republicans had the short straw of kind of being in charge in 2000 and 2008. When we had, the tech bubble and the accounting scandals and all that stuff. And in 2008, obviously the GFC. But you can see here again, historically, stocks have done better when a Democrat is in the White House. But we're going to talk about some of the other things here. What we found is when you have a split Congress, which is kind of where we are now and where we think we're going to be when all is said and done. Split Congress stocks have done way better. All right. The last 13, another one we knew coming into this year, last 13 years, split Congress, you know what happened? Stocks went up. All right. So that's something to think about. This year's probably going to be 14 unless we have a really bad fourth quarter versus unified. And why is that? Checks and balances, not too much power one way or the other. That's kind of how this shakes out. And I mentioned, give something for everybody. When the Republicans have both chambers of Congress, Senate and House, stocks do way, way better. All right. So they do way better than the Democrats have both chambers of Congress. So, but kind of what we would say investors should be rooting for is kind of this idea of a split Congress. You think about how things are right now. There's 100 seats in the Senate, right? 51 Democrat, 49 Republican. Then you go to the House. Republicans have the smallest House majority in 140 years. All right. So that's gridlock. That's kind of why we think things that have happened in the past, Inflation Reduction Act, It wasn't about inflation reduction. It was about batteries and EVs. Okay, that's okay. Technology stuff, that's good. Oh, what else do we have here? The CHIPS Act, right? Bringing things home. We don't like when China goes on lockdown, shutdown, and we want our chips for our phones and our cars and our remote controls and our TVs and all that stuff. So we're bringing that home. CHIPS Act, something both sides of the aisle agreed upon. And when you have gridlock, that can be good. The thing the government or the thing the stock market doesn't like is red waves, blue waves, too much power one way or the other. Because then you can spend too much and get too frivolous. And markets don't always like that. So again, that division is kind of not division, but I guess division. Split Congress is what we're looking for. But with the Senate, you got 33 seats up for re-election. 23 of them are Democrats defending those seats. So right away, it's a tougher map. That's what they call a tougher map for Democrats on the Senate. A lot of those states were states that Trump did really well in 2016, by the way, that potentially could flip back. So it's assumed that the Republicans probably take the Senate by a little bit. Then look at the House. Exact opposite. The Democrats have a much, much easier path to gaining some seats when it comes to the House. All in all, we think things are going to flip-flop, and you'll still have a divided Congress. Now, Sam Stovall, big fan of Sam, he says, the old saying goes, if the opposite of pro is con, then the opposite of progress must be Congress. There you go. But it's not about red. It's not about blue. It's about green. So I mentioned stocks do better under under Republicans when they control both chambers of Congress. Do a little bit worse when Democrats. You can see that blue and red. It's about green. When you have that split Congress, that's the returns. But here's what you really need to know. Since 1953, if you took $1,000 and only invested in Republican presidents on the stock market, you'd have about $29,000 right now. Same $1,000 only to Democrats. Have about double that almost, about 56, 57, 58,000. That's the power of compounding over time. It wasn't a huge gain, a huge difference per year, but over time and more Democratic presidents, you have a larger gain. Here's what you need to know. Take that same $1,000 and invested the whole time. Did not pay attention to who's in the White House. Just stayed invested. $1.8 million right now. All right. That's kind of the thing that we really tend to stress when I'm talking to financial advisors and their clients about the election and trying to invest in so-and-so. And I mean, believe me, I do this every day. I hear this every day. Oh my goodness, if she wins, I'm out. If he wins, I'm out. What I'm getting at. And we hear that all the time, but let's just remember that how the economy is doing, how inflation's doing, potentially what the corporate tax rate is up to. Some of those things really, really do matter more than who's in the White House. Of course, who's in the White House matters. I'm not minimizing it. I'm just saying there are some factors that tend to matter more. So let's talk about Congress. There's all the different splits, different scenarios, if you will, what potentially could happen here. So we'll see how it all shakes out. This is one of those cool charts to at least kind of be aware of. Now, honestly, if you talk to a statistics teacher, they say this is a really small sample size. You could throw it all out the window. I don't want to quite go to that extreme, but I still am in the camp that last 13 years of split Congress stocks were higher. This year's going to be 14. That's probably where we're going to be when we wake up November 6th, assuming we get the results right away. That's where we could be, and that could be something most investors should be looking forward to. We're doing time-wise. Oh, my goodness. I go long. I always do. I'm going to wrap this up soon. The more things change, the more they are the same. Alphonse Carr, I like that one. So what's not going to change? Defense spending historically was very low relative to GDP this time a year ago, like the lowest since the early 80s. Look around the world. Look around the globe. Defense spending, whoever wins this election, is probably not going to slow down. It's going to continue to improve or increase is probably the better word to use. And what does that mean? Well, listen, defense is a big part of industrials. We don't see a recession. We think industrials are a group that whoever wins is probably still going to do pretty well into next year. And again, this defense spending is honestly potentially a tailwind for the economy. We saw in the 80s, a lot of defense spending. I mean, the government can spend money a lot of different ways, and I get it, defense spending, buying missiles, doing things, but no one's crazy about it. But the reality is these are some things that can create potential GDP growth and this overall spending, overall growth down the line. We're the largest oil producer, about 13 million barrels a day. That isn't going to change, right? I mean, we're seeing that under, obviously under President Biden. We saw that under President Trump. We don't think it's going to change if Trump or Harris win here, that we are the world's largest producer. Listen, and you hate to say, what are the most dangerous words? This time is different. Sir John Templeton, 4 most dangerous words. This time's different. It is different because the terrible things that happened on October 7th last year, oil spiked initially. What's oil done? I mean, oil spiked here and there, and the war is still going on. The Middle East is still in turmoil, but it's not like crude oil is just soaring way past 104. Crude oil was like $145 back in 2008. All right. there's some deflation there, I guess you could say. And maybe there's different reasons why crude oil, but one of them is, again, the United States is pumping more oil than ever. I think I've got the number here. Yeah, production's doubled since 2011. All right, what anything else here? Production pulled back in 2015-16 amid a weak economy. So yeah, production pulls back a weak economy. We're not sure there's such a weak economy coming, but all in all, we think production is going to remain strong. And with some of the issues out of the Middle East, well, the U.S. can pump a lot of oil now, right? This time is different. 73, 74, oil embargo. We couldn't do that, right? We did not have the luxury to do that back then. So this is something that's probably not going to change. I could spend a lot of time on this. I'm not going to. The US dollar is still the world's reserve currency. As long as anyone listening to this, we have the world's reserve currency. March of 20, what happened? Stocks were killed, bonds were killed. Look it up. Gold did not do well, March 20. You know what went up? The US dollar, the cleanest shirt in the dirty laundry. I'm not saying it's great, right? We've got problems, we got issues, but during times of stress and fear, when the you know what hits the fan, people flock to the dollar. The first 10 months of 22, when stocks were doing terribly and bonds were doing the worst they've ever done, the dollar had like its strongest first 10 months to a year ever. So the first time we have a major crisis and the dollar is not a safe asset that people go to catch a bid, then I'll worry. But for now, we don't think it matters who wins this election. We have the world's reserve currency. And when you have the world's reserve currency, can you play by a different set of rules? Listen, I don't like a bunch of debt either. I'm not crazy about it. You're not crazy about it. Every time I speak, people say all about all the debt the country has. But when you have that world's reserve currency, maybe you can, to a degree, play by a different set of rules. And that's just the truth. In 1972, when gold was severed from, dollar was severed from gold, John Connally, room full of bankers for Treasury Secretary for Nixon, said, you know what? It's our currency, but it's your problem. That, everyone, has been the attitude of debt ever since. I'm not saying it's right. I'm not saying I like it. I'm just saying when you have the world's reserve currency, and every time there's a crisis, we are reminded we do have it. That means you maybe can, to a degree, play by a different set of rules. George Carlin, bipartisan, usually means larger than usual deception is being carried out. They would try to cancel George today, but I think we could really could use him right now. This is just some different stats and figures and stuff we look at. I mean, the US dollar is still being used. You hear things like, oh, people in the Middle East aren't going to take the dollar, to do oil. None of it's true. All right. That's just media stuff. It's not true. They are taking the US dollar. Look around. I mean, I got the numbers there. Asian Pacific, what is this? 74% of all the transactions use the dollar. The rest of the world, a lot of dollar. Now, maybe not as much in Europe, but you know what? They've got the euro. They'll take your dollar in Europe. You ever been to Europe lately? Oh, they're going to take your dollar. Doesn't mean all those transactions are that way because they're using their own currency. But around the globe, people still take the dollar. The media hype up about Middle East and different countries not taking the dollar, this and that. Maybe Iran might be doing their own thing. But listen, the reality, Iran will take dollars if you give it to them. But the reality is, hey, the dollar's not going anywhere, and we're not seeing any reason to change that. This is just some more context on that. I'm not going to spend a ton of time on this. You can kind of glance at some of these things, but again, foreigners are quite happy to keep. They take our dollar when they buy. I mean, the foreigners sell a lot of goods to Americans. They get a dollar in exchange. The foreigners don't always buy an equivalent of U.S. goods with U.S. dollar. Instead, they choose to keep that U.S. dollar or U.S. financial assets like treasuries, which, hey, the U.S. is quite happy to supply that. So that isn't changing no matter who wins the election. I'm almost done. Hopefully kind of hit my mark here time-wise. Groucho Mark, politics is the art of looking for trouble, finding it everywhere, diagnosing it incorrectly, and applying the wrong remedies. That's some things. I think I might be my last one. So with all that, again, thank you for having me. Thank you to everyone for listening. This was a lot of fun. I know I talk fast. I get into it. The TrendSpider team invited me to do this, and I've really enjoyed getting to speak about these things. I'm out there. I'm sure there's links and things. I'm on Twitter at Ryan Detrick. CarsonGroup.com/research is our blog, and then Facts versus Feelings is my podcast where Sonu Varghese and myself talk about all this stuff that we just shared, all these charts and things I just shared every single week. So listen, it's an honor. I hopefully get to do this again. There's a lot of amazing speakers. I can't wait to listen to a lot of the other speakers. Hopefully you get some time and check those out when you have time, because this election is very important. The reality is, wherever you side, just get out there and vote, right? Get out there. You have a voice. We all have a voice. It's very important to get out there and vote. And then as a market strategist, we would say, let's hope for a split Congress. Because that's maybe the best scenario for those investors out there. So without, again, everyone, I'm Ryan. I'm honored to have been here. Thank you so much for listening. And I don't know who is after me, but I'm sure it's a great speaker. So enjoy, keep listening, and we'll see everybody next time. And Yeah, just reach out if I can help. But thank you again to TrendSpider. See everybody next time. Thank you.
Thank you, everyone, for joining me here today. I'm looking forward to talking about how the 2024 election is likely to impact markets and how I'm positioning myself. I'm Matthew Caruso. I'm a former market maker, full-time professional investor, and I'm happy to walk through my perspective on the market, both from a top-down perspective and also how I'm looking to actually position through individual stocks. I do always focus on the impact of elections, but my view is always you need to kind of overlay that with the actual dynamic trends that are going on in the market. Nothing really happens in isolation. So we're going to be able to kind of take a look at those two together and how I'm trying to marry those two different driving forces in the market come this November. So let's get started by kicking off and taking a look at the high-level view of what we're dealing with come November. So looking at both Donald Trump and Kamala Harris, in my opinion, we really have opposing economic views, not just in terms of what the stated goals are, but really about how to get there. And it's really quite interesting. So, I would put, these are obviously generalities, but I would put Trump more in kind of a bottom-up type of perspective. So it's more about kind of deregulation. I mean, by bottom-up, I mean, let the individual economic agents work on their own rather than being guided by government as a whole on the margin. That's where I would say he's aiming towards. I think a big push at deregulation is great in terms of promoting economic strength. Having Elon Musk as someone who's volunteering, who's already one of the world's best entrepreneurs to kind of be on board to take that on is, I think, something that would pay dividends not just for the next administration, but for many, many years into the future. So looking at deregulation, that's going to have significant impacts on who wins, who benefits, and who will struggle on a relative basis. So something that's important to pay attention to. On the other side of things, what's interesting is although he tends to be, I would say from that perspective, a bottom up, but there is that strong perspective that he has that is really driven by the federal government, which is his view on tariffs and international competition. So he's pro-domestic production, so he's pro-tariffs in a lot of cases, specifically when there's foreign competition that he argues is not fair competition or being subsidized or whatnot. In general, Trump is in favor of lower taxes. What's really interesting, both Trump and Harris is both having already served in federal government. Trump as president and Harris as vice president. We get to hear about what they plan to do, but we also can see what they've actually already done. So I would really put Trump in the situation of being in favor of lowering taxes on a broad spectrum. And in general, some of this is maybe qualitative and perspective, but I would say in general, Trump is more of a pro-capitalist type of mentality, whereas Harris is more on the socialist side, I would say. So when you look at kind of Harris, and I put, her view is, I would say, tends to err on the side more of increased regulation. Again, more of a top-down perspective. I put, Newsom as just an example. She's also from California, and I think a lot of that kind of ideology is consistent in how there's always, if you look at California, which is something that, a governor has a lot more direct control over, and not to say that they have the exact same views, but, things like climate change is usually pro-regulation. AI, which is just a really dynamic and important industry and I think revolution in a sense, where you can see California is kind of leading the charge in terms of regulation of how that's implemented. So that, again, has winners and losers. Pro-centralization, tends to be that I think Harris's camp would be more the federal government plays a larger role, and again, pro-socialism. So I thought we can argue about both sides about who's better and what the outcomes are and what the outcomes can be. But I thought it'd be great to kind of take a second and actually look at a couple of international case studies that we can study in real time that are actually going on that I think are incredibly relevant, where you can kind of compare these two different outcomes. So let's switch to the charts and take a look. So in discussing the two different viewpoints on economics, I think it's really interesting that we basically have someone with a very similar agenda to Kamala Harris here in Canada, where Prime Minister Justin Trudeau has very similar policies in terms of immigration, in terms of economics, in terms of taxes, I mean, a lot of similarities. And so basically I said, let's take a second and just from a top-down level view before we get to the individual stocks, because although the stocks are important, it's a rising tide lifts all boats, or it could be, just a difficult environment for everyone. And if we take a look at the two, so when this vertical line here is when Justin Trudeau was elected into Canada, and here we have the S&P on the left side, we have the Canadian ETF on the right side, and at the bottom I also wanted to show gross domestic product per capita for both countries. So how much each person their share that they get to take home from the of total GDP. And you can see here over this period from when Justin Trudeau was elected, US GDP per capita has grown 45%, whereas in Canada it's only grown 22%. Similarly, if we take a look at stock market performance, the S&P 500 is up 175% over that period, whereas the Canadian ETF is up only 78%. So this is a really interesting comparison because very similar economies cultures, we're neighbors right next to each other, and Trudeau becoming prime minister really had a very large departure from what was already in place in the country prior, and he's really put into practice a lot of the kind of stuff that Harris is focusing on. It's difficult because obviously there's the actual what will be implemented, what are their viewpoints. Right now, for a lot of things, we're still kind of looking at what they say they want to do. But just to get an idea of not necessarily, the words capitalism, socialism can be sold out, thrown out and have, big emotional responses to them. But if you just take a look at it, from a top level view of the impact of having more socialist policies, it's not the end of the world. We don't spiral into a disaster, but it does likely lead to a less than possible outcome. It results in a less than optimal economic outcome. And so that's really interesting to compare these two. But to go one step further, I thought it'd be interesting to look at the other side of the spectrum. So similarly, at the same time, if we take a look at Argentina, now this is not as perfect a comparison. The cultures, economies are a lot more different than Canada and the US. But if we take a look at this one moment, and if we take a look here at Argentina, they had a new government elected with Milei, and he is a very kind of pro-capitalist, deregulation focused leader. And what's interesting is from when he was elected in the fall of 2022, we can then compare this with what's gone on versus the US. The Argentina ETF is up 112% to the end of September, whereas the S&P 500 is only up 40% over that same period of time. So it's really interesting to see kind of the more socialist policies of Canada led to a less than optimal outcome in terms of economic performance and as well stock market performance. It's a little early to look at just the economics of it with Argentina, but you can just looking at stock market performance, it's a pretty dramatic difference. Now, obviously, it's a smaller economy, so there's different impacts, and obviously, they came from a very bad situation in terms of inflation. But it's just interesting to see how taking a dramatic shift on economic views, going after deregulation, and allowing individual actors to kind of lead their future rather than have more of a top-down view, has led to a very powerful stock market. So, in my view, depending on who gets elected. And even at a federal level, there's only so much power someone has. But in general, I think a President Trump presidency would probably result in stronger general economic growth, stronger stock markets, and more economic prosperity. Where I think Harris would be the lesser of the two. I think looking at what Canada has done versus the U.S. is probably a good example of what can be under the two different administrations. So let's go a little bit further before we get to stocks. That's kind of the high level view of what I expect to take place. But going down a little more into the details, I really think Trump is, like I said, is more of a risk on situation. I think I put Harris as a risk off, but in my view, it's really more about a hot market, what can be a hot market, versus what would just be a warm market. I think in general, the US has very positive trends building forward. They're still leaders of innovation. There's always different issues, such as which I think is excessively high debt. But interestingly, neither person has very strong policy about reducing that debt load. Both are larger spenders, and neither are very pro austerity. So just in comparing both people, I would view Trump more as a risk on with a broadening market. By focusing on domestic production, by focusing on lowering regulation, that helps small to middle-sized companies over their large counterparts. Although regulation is usually looked at as a way to protect consumers and protect different people from different perspectives, the result is, though, however, that it does tend to help, or on a relative basis, large companies, because regulation, even if there's a proper purpose for it, it does increase cost, and small, medium-sized businesses are less able to bear those costs than the large competitors. In fact, a very highly regulated market usually results in less competitors and larger competitors for those that are left behind. So I think Trump ends up with a broadening market as companies can be more dynamic, they have less red tape, they have less costs, and that really kind of boosts entrepreneurialism. Whereas a Harris election, I think, would be a little more risk off on a relative basis and would favor established incumbents. But I want to go a step beyond just kind of discussing generalities. Let's take a look at exactly what I mean by comparing two different ETFs. So here in the upper chart, we have the S&P 500. And down here, we have what I think is a very interesting relationship. We're looking at IWP, which is the mid-cap growth ETF, divided by the S&P 500. So when this is climbing, it means mid-cap growth stocks are outperforming the S&P. And when this is falling, it means the S&P is outperforming. Both, and obviously, the Biden presidency is not Harris, but she is the vice president. So I think there's, in general, similar views to Biden than to Trump, obviously, of course. So taking a look at the dynamics under the surface, this ratio, in my opinion, is really what describes a hot market versus a warm market. So the kind of market that active traders like, one where there's many stocks moving, there's dramatic moves in growth in growth stocks. I've always been a growth investor. This kind of market where mid-cap growth stocks are outperforming tends to be a hot market where there's a lot of activity and there's dramatic moves for individual companies. Whereas you can see when Trump got elected back in late 2016, almost immediately, this relationship started to move in favor of mid-cap growth. Interesting, even despite the whole COVID pandemic and all the kind of money that was sprinkled on the economy, we saw a lot of that ended up funneling through towards mid-cap growth, which dramatically outperformed the S&P 500. Interestingly, from when Biden was elected and really from when he basically took office, the ratio peaked, and it's been very much one way down. But what's particularly interesting is that mid-cap growth tends to do well in bull markets. But not all bull markets are created equally. So you can see it's interesting, although the S&P 500, especially this last leg from October of last year until now, seems like a pretty steady advance, it has been dominated primarily by large cap companies. It hasn't been led by young, dynamic companies. It's been more led by incumbent companies. And again, that kind of falls in line with, I think, the priorities of the administration. So I think this is a good example of how the S&P has advanced under Trump's presidency, it advanced under Biden's presidency, but the character has been very different. And so when, again, we're discussing how it could be a hot market versus a warm market, that really comes down to which stocks you want to position in and how you should expect them to perform, and really where you want to allocate your companies amongst not just sectors, not just market caps, but also styles of companies. So higher growth companies, mid-cap growth companies. If you're a higher growth investor, I think a Trump presidency would do better for you. And if you're someone who's more focused on incumbent companies, you like companies that are established and that are growing incrementally over time, I think on a relative basis, you would do better under a Harris presidency. But let's take a look now at the individual company names, individual themes that I think are going to be successful going forward. So again, my background as really a growth investor, a stock picker, really comes down to how do I use the general environment to find the next great growth companies with potential upside, the substantial potential upside. And this is really where I think politics meet innovation. The fundamental principles of the U.S. Allows such dynamic companies to keep coming to market. And so in general, I think the U.S. is in great shape. AI, although it's thrown around and it's almost even difficult to say sometimes because it's just so overused at this point. But the reality is with literally hundreds of billions of dollars being spent on infrastructure solely to power AI. Just recently, Microsoft signed a deal with Constellation Energy to reopen 3 Mile Island nuclear plant in Pennsylvania. specifically to power green energy for their AI data centers. They signed a 20-year deal to do so. We're getting significant investment. Microsoft also partnered with BlackRock recently to create essentially a $100 billion fund to invest in AI infrastructure. So this kind of money being spent is only being done if there is really substantial opportunity going forward. And I do see that substantial opportunity. So let's take a look at these stocks one at a time and the different themes. In my opinion, the biggest driver going forward is going to be the AI theme. Every era in the market, every big bull market always has a key theme that tends to lead. 90s was internet, obviously. During the 2020 COVID bull market, everything was about staying at home, work from home. Every cycle, there's always a very strong theme that will lead. Earlier years, it was the software as a service, which was a really big kind of revolution in terms of pricing. So the current era, in my opinion, is really AI, and I think this is going to have such a massive change to the way people do business. This has legs for quite some time. So the key industries that I'm looking at going forward are energy infrastructure, which I think is an absolute key. Autonomous driving, which I think is going to be one of the first really big industries to be changed by AI. And it's funny, when I started as a market maker, I remember all the algos, basically, which now we'll call AI, but all the algos kind of started. And as traders, we thought, oh boy, they'll never replace us. This is such a complex business to do market making and all the rest. And this is the last thing that they'll be able to do with computers. Well, fast forward, and most trading is done by high frequency trading and algorithmic trading. So I don't have a doubt that autonomous driving will be solved. And there's already been a lot that's taking place there. We'll talk in a second. But that really is an application of AI, and the transportation industry is such a huge market and it has such a large possibility to disrupt how we live our daily lives. I think that's something that deserves a lot of attention. And then it comes down as well to defense is always important. Housing's been an issue. And with all of AI, there's identity and regulation. So let's take a look at these one at a time. First off, let's talk about GEV, because I really have this under both presidents, because I just think it's a great company, and their diversified operations really allow them to do well in all situations. So GE Vernova is a recent spin-off from General Electric. They split the company into three different portions. GE Vernova is the portion that works on energy. So they have three different divisions. They have oil and gas, they have wind energy, which is renewables, and they have small modular reactors, which is nuclear. So they really have kind of the their position in really all of the important markets. So with this very large build out that's taking place for AI, and just in general, electrification, even under Harris, there's a constant push more for electric vehicles. So there's going to be more and more demand on the system for electricity. I think AI has just kind of really fast forwarded that progress. So if we take a look at GE Vernova, they recently IPO'd, they had their first rally off of that IPO, and they went through a very healthy basing structure. From here, we've had a substantial advance. And this may look like it's extended, but from the big scheme, the big perspective of the amount of growth coming to this sector, I still think it's early days. And I think they're perfectly positioned to be able to support the growth for AI infrastructure. So yes, this is extended from, this is its 10-week moving average, the same as its 50-day moving average. But it's really interesting to take a look at what GEV is doing at the same time. If you kind of compare that to what the S&P 500 has done, which has also been strong, it has been substantially stronger than the S&P 500 over the same period of time. So I think GEV is definitely a leader in the market and a leader within a key theme. Looking at how to position through this, so we do have earnings coming up in just about a couple of weeks. But as a very, very strong leader, barring some kind of extreme disappointment on earnings, this is a stock that I'm constantly looking to add to my position. I was lucky and fortunate enough to build positions in this area here as it was coming out of this basing structure. And this is one where it is extended in the short term, but this is one where I'll be looking to buy on any kind of weakness. It is a utility, so it's unlikely for this to stay so extended for a prolonged period of time. But rather, as a utility, this is something that usually, as it pulls back, becomes a very nice buying opportunity into a key theme. So again, whether it's Trump, which again, deregulation will probably push AI infrastructure to be grown even faster, but under Harris, equally, there's very strong demand for electricity, whether it's going to be AI or also electric vehicle incentives. I think GEV is extremely well positioned to benefit from both of those. However, in addition to GEV, one that I think would do even better under a Trump presidency would be Cameco. So if we bring up Cameco, we spoke about the nuclear energy and the reopening of the plant in Pennsylvania. The uranium market is one where there's a couple of main players. There's Kazakhstan, which has they're basically the Saudi Arabia of uranium, and number two is Canada, also has dramatic deposits. For many years after the kind of the Fukushima disaster, if we take a long-term picture of Cameco, and we go back in time, that was in 2011. You can still see the gap down from when there was that meltdown in Japan, and basically nuclear energy became an unwanted energy source for many, many years. So it's interesting to see how this went from an energy source that completely was not wanted to suddenly reopening nuclear plants, which is a very big decision because these are plants that you need to have substantial supplies, substantial uranium on site, so you can always keep energy moving at a constant pace. So the main business in the uranium business is long-term contracting. They don't usually work off of spot like the oil market. Their focus really is on long-term contracts for sustained supply to all of the different reactors. So there aren't many players in the market to begin with. There's the Kazatomprom, which is from Kazakhstan, and there's Cameco, which is Canadian. Now, obviously, if there is a push for more domestic or at least friendly supplies, I think that positions Cameco as a unique opportunity in a space that's building out. I think what's interesting is, again, there's not a lot of open supply because for so many years, this was a no-go industry because nuclear was pretty much dead. So suddenly from going from no interest to suddenly a lot of interest is going to put a lot of upward pressure, I think, on uranium prices if this trend persists. I mean, Google's already spoken about looking to reopen nuclear reactors as well. So it looks like a developing trend. And I think under Trump, if his focus is about domestic or friendly supplies, I think that plays well to Cameco as a major. And if you take a look also at their earnings, you can see their earnings line here, how earnings have dramatically changed from a relatively poor situation just a couple of years ago to where now Cameco is printing some fairly nice earnings per share. So some pretty steady growth year over year for the different quarters, which is impressive overall as a trend. A very small cap or focused domestic opportunity, I think, would be UEC, Uranium Energy. This obviously is a small cap stock, so it's not really, doesn't have the same kind of stability as a Cameco, but their operations are almost entirely US based. And they spent many years putting together their production profile. So I think if there is a dramatic move in the uranium price and there's a continued push into nuclear, I think specifically under Trump, these companies stand to benefit quite a bit. The next theme I'd like to take a look at is Tesla. So we spoke briefly about autonomous driving, and in reality, I don't think either administration would hamper the developments in the industry, and if either Musk or a competitor would develop autonomous vehicles, I think in general this would be a net positive for society. But obviously, with Elon Musk being a substantial supporter of Donald Trump this election and having a super PAC, speaking at his rallies, I think clearly it'll just be that much better for Tesla if they have a competing product versus another competitor. But really, I see this as a broad trend. But obviously, Musk having such a close relationship now with the president will obviously, I think, be, if anything, in a slightly better position than some different competitors should Trump be elected. Taking a look at Tesla, we've been in a prolonged sideways consolidation pattern. This had a dramatic move up into 2021. It's interesting. This is still trading at a very high multiple relative to other car makers. I mean, if you're taking a look at Ford and others, I mean, these are very low PE stocks, whereas Tesla is trading at a much, much higher multiple. And in reality, I think there's been a lot of time taking place here where people see all of the ancillary businesses in addition to electric vehicles that Musk has been working on. For it to command its multiple, I think he has to be able to bring those finally to market and show them, or eventually the market will be disappointed. But you can see here from a technical perspective how really the opinion on Tesla is getting closer to a unanimous opinion. The volatility is condensing. We're going to find out very soon, are the bulls correct and we break out to the upside, or will the bears be correct and we'll break down to the downside? We have the robo-taxi from, as we're speaking now, the robo-taxi event will be taking place tomorrow night. So it'll be interesting to see what Musk does and if it can break out of this pattern It could be short term if good news is announced, or even maybe down the road if it's something that will take some time. But greater visibility is going to be very important here for Tesla. On the kind of the other side of the spectrum, we can take a look at Uber. Uber, I think, is an interesting play as well here regarding autonomous vehicles. Autonomous vehicles are going to be very capital intensive, especially if you're coming to market simply as an autonomous vehicle solution. So there's Waymo, which is part of the Google family, where they have many autonomous vehicles already driving in California. And they just signed a deal with Uber as they want to bring some of those vehicles to Atlanta and Austin, Texas. And they want to put those on the Uber platform, which is different from how they're operating currently in California. So I think Uber stands in an interesting place to become the, basically, I guess pun intended, to become the toll of autonomous vehicles, because I think autonomous vehicles are so capital intensive. Anyone who's running a autonomous fleet, a specific autonomous fleet to be put out as a taxi service, you're going to want to get the most use possible out of your vehicles to be able to increase your return on investment. So yes, maybe you have to pay Uber their share to be on their platform, but having already what is the largest marketplace for transportation right now is Uber, I think it's a must-be to be on that platform. And I think not only will Uber have the opportunity to get all of these new autonomous rides, I think once autonomous vehicles get to scale, the cost per ride will drop significantly once there's no longer a person needed to drive the cars. And then after that will be a real competition for an entire different market, which is the auto market in a sense, because people won't necessarily be buying traditional vehicles. They'll probably be, in a lot of the marginal cases, they'll just be using Ubers with lower cost autonomous vehicles as an option. In a lot of cities, if you live in a downtown city, just the cost of parking spots can be $20, $30, $50, $60, $70,000 just for a spot, in addition to registration for your vehicle, gas, insurance, and all of the rest. We've seen how high car insurance premiums have been going recently. So I think if this becomes mainstream, Uber stands at a very unique crossroads to become a substantial player in transportation in general, whereas right now it's really kind of disrupted the taxi business. I think it can help disrupt the entire automotive business in general, the transportation business. So really interesting. And I think they're uniquely positioned to take this on. And the recent partnership with Google, I think, is a good example. So whereas I think Tesla is a kind of a pure play in terms of Musk's relationship with Trump, I think Uber is kind of the broader opportunity that's available at the moment, where AI meets transportation. Another kind of company that has been vocal, in terms of Trump support, has been Palantir Technologies. And again, this is interesting because they're just now attempting to break out of what was the highs of their IPO. But this is being regarded, in my opinion, finally being understood as probably the first pure play software solution for AI at an enterprise level. I mean, everyone has, I think ChatGPT is what got everyone excited with AI. It's what helped lift the NVIDIA stock. I think people are now recognizing that, for a lot of, especially enterprises, large companies who want to bring on a lot of this capability, it's still not so simple that you can just plug a chatbot into it. So the capabilities are immense, but you need the right software infrastructure to be able to onboard enterprise clients. I think that's where Palantir fits in this equation. But what's particularly interesting about Palantir is they also have a very strong defense business as well. Trump is a very pro-defense president. He's all about always mentioning how he wants to rebuild the military and all the rest. I think going forward, a lot of the military budget more and more is going to go towards software. Whereas in the past, a lot of the physical manifestations of war, such as planes, et cetera, General Dynamics, Lockheed Martin, all the rest, have been where they've gotten most of the dollars in terms of defense budget. I think Palantir is going to play a bigger and bigger role. And again, given kind of the general support for even Palantir employees and all the rest for Trump, I think this stands to benefit both from a Trump presidency and just the incredibly strong tailwinds into AI, general AI adoption, and as well as AI adoption in defense. So Palantir is one that I'm watching very closely from that perspective. Again, this has had a strong move, but big picture, this is just breaking out of its very large IPO basing structure. So again, they are taking on massive markets. We spoke about the defense market. They have taken on very big contracts in the health market. They've work very closely with the UK's national health system to bring down the cost of operation for hospitals, to speed up and optimize health delivery. So again, tackling very big businesses, very big total addressable markets, I think they have a huge runway in front of them. It's interesting, if you hear the CEO speak, his viewpoint is really kind of, which countries do they allow to use their software in terms of defense? Whenever you have a product where you get to kind of decide who is allowed to use your product, I mean, that's a very powerful position to be in. And that's one usually only in a leadership position. So one, I think, very well placed stock to benefit from the Harris administration would be the rocket companies. So their focus is they are the biggest lender. They're one of the biggest mortgage originators. They have tremendous scale within all the housing market in terms of mortgages and all the financings and the rest. If you see here, I want to bring up this chart where you can take a look at, here we have the TLT in the upper panel, which is the long-term bond ETF. And down here we have the rocket companies. So you can just see very clearly the very strong relationship between bond prices and how the rocket companies are doing. Obviously, as interest rates increased, as bonds fell and interest rates increased due to inflation, that put a lot of weight on the housing sector. A lot of people who had long-term mortgages were basically frozen into their mortgages because they didn't want to break their fixed rate and refinance at a higher price. So that put a lot of pressure on the refinancing, the financing market, which I believe is beginning to unfreeze. What's important, though, I think, is if we take a look, these blue background is my proprietary Caruso Adaptive Relative Strength tool. What it does is it compares the stock versus the benchmark you're comparing it to, but it adjusts for the relationship between the two. So if RKT is more volatile, and if it has a very strong relationship to the underlying ETF, that'll come through in the calculation. This allows you to kind of compare companies of different volatility, companies from different with different correlations, and still get a good understanding of what the relative strength relationship is between the two of them. So if you see in this situation here, I'm comparing RKT with the TLT. And so although it had underperformed during this big drop, ever since the bottom kind of came in, on all of these different rallies, this really started to outperform the TLT. But you can see really starting here back in October of last year, and throughout this, even this basing period, RKT has really been the place of strength versus TLT. What's interesting is we can also switch this over and compare this to the S&P 500. And you'll see that, interestingly, although this has been lagging for a tremendous amount of time, just as of recently, not only is this now outperforming bonds, it's also been outperforming the S&P 500. And this is taking place really even with bonds having recently given back a lot of their recent gains off of the bottom. So my belief is that ultimately bonds are in a bottoming phase. And should they break out to the upside, I think RKT will lead. So I think with Harris coming to, with one of her key economic promises is to kind of increase home affordability. She wants to provide down payment assistance. She wants to promote home building. I think RKT stands to dramatically benefit both from the tailwinds of Harris supporting the housing market, as well as just the dynamic between bonds and RKT. I think just with bonds putting in a bottom, with yields topping out, this is a process, but ultimately I think they top out and bonds rally and yields fall. I think that's going to support higher prices for RKT. How this comes together with the AI theme is with RKT being one of the biggest data pools available right now on lending, financing, refinancing. They are really kind of adapting a data-first policy at the company to incorporate AI to become the real leader in the space. So their viewpoint, and what I love to see with management, is that they have such a aggressive plan for how to take a bigger share of the market. They want to become the leader of their market, just like Amazon.com is for e-commerce. They have stated that's their goal for their respective market. And it happens to be a very fragmented market at the moment, far more fragmented than e-commerce. So they see a very large opportunity to use their substantial data pools to be able to use that with AI to provide unique services, to provide better customer service, to provide better response times, to provide better sales support to their staff. So I think if they are, just like in the 90s when all the companies that were first to kind of move to adopt the internet and bring it in as part of their operations, they typically led in their industry groups. I think the same playbook is going to be taking place now for different industries. I think RKT is one of the first to kind of deploy it in its industry. It's interesting because it's been a difficult time for this industry because of bond prices and the real estate market, but that hasn't slowed them from investing into the business. Whereas a lot of other people have kind of like held back and just trying to survive the winter of higher interest rates. RKT is actively working to kind of build out their presence, build out their functionality. And I think that's coming through by seeing how this has been really dramatically outperforming bonds. And although the correlation is still there with bonds, you can see on a relative basis where bond prices made new lows in October, RKT did not. Whereas bonds have basically been unable to take out their December highs, RKT has. I mean, even on this pullback, RKT is still above its December highs, whereas bonds are obviously right back inside its basing structure. So the relative performance is very strong. And I think not only does it have AI and interest rates as two different wins in its sails, I think a Harris presidency with her focused support on housing will do even better to help out RKT. The last stock I'd like to cover is another young dynamic company, which is YOU, which is Clear Secure. One of the main reasons I really want to speak to kind of Gavin Newsom in California and kind of his views even on AI in terms of regulation. One was to kind of compare his policies with Harris, who's also from California and usually has similar viewpoints. But also specifically, I want to mention that because with Clear Secure, I think it's going to have a very, very strong future, even stronger future with a Harris presidency, because their focus is really about identity and verification. So they began with helping people get through airports a lot quicker with pre-verification and all of that, so you can pay a membership fee and you can get to your gate a whole lot quicker than going through all of the usual TSA and all the different checks. But they've really expanded their business to where now, for example, on LinkedIn, you can verify with a government ID that you are who you are. And that's done through the Clear Secure platform. I think, Warren Buffett was speaking recently about how he said he doesn't know how AI is going to end up, but he mentioned about how one thing he's sure about is that it's going to be a massive bull market in fraudsters with the use of AI technologies. And I have to absolutely agree. So I think Clear Secure has a bright future in terms of the importance of what verification will be going forward. If people can fake images, fake voices, fake text, you're going to need a way to verify who is who on the internet. I think Clear Secure is very well positioned to do that. You can see they broke their long-term downtrend line. It's a young company. We broke higher right through this trend line. You can also see the very massive volume spikes that came in on this advance. You can also look at the tremendous growth in earnings per share for you. And it's been doing this while the stock has been under pressure. I think the market's starting to appreciate the broader story about verification and going beyond just the airport and how Clear Secure can be a unique winner. What's very powerful about their platform is once you're on their platform, you can very easily verify at many different businesses rather than just the one business that you verified with once they have kind of your information, all the rest. So it becomes a sticky business. It becomes one where the more it's used, the more powerful the platform is. So I think they have some significant tailwinds. And again, if Buffett is right, and he tends to be in the long term, this can serve to be a tremendous opportunity for verification. And Harris being more in terms of, along the lines, I think in terms of regulation, with especially around AI, if we take kind of the playbook from Newsom in California, that will only add even more, I think, strength to the use case for Clear Secure than under a Trump presidency. So I thank you very much for your time today. It was a pleasure here speaking with TrendSpider. I'm very optimistic about the future under both presidents. I think just from a purely economic perspective, as mentioned, I think Trump's policies would have more runway for markets and the economies in general. But I think the AI theme is so powerful. And if we can look past just the NVIDIA growth story and we look at really what that is going to power going forward, I think that really starts to unlock a number of really unique opportunities. If you'd like to learn more about me and have a look at a special offer that we have specifically for this TrendSpider event, you can join me at carusoinsights.com/TrendSpider, where you can learn all about my process and how I take all of these themes and my short-term timing techniques learned as a market maker to find really good risk-reward setups in the market. I appreciate your time and best of luck in the markets and through the 2024 election.
Hello, everyone. We are thrilled to be part of TrendSpider's Election Playbook event. Now, there's a lot happening with this election. It's highly contentious, even compared to other recent elections, and traders are looking for how to position themselves both into and out of November 5th. For those of you who don't know, I am Brent Kochuba, founder of Spotgamma, and we provide analysis of how the options market is driving the underlying stock market. And there is a lot that the options market can inform us of, including what volatility expectations are and what positions are being taken in the market. So what scenarios are possible for this election? Spotgamma's options-based analysis reveals two potential scenarios, one bullish and one bearish. On the bearish side, if the uncertainty around the election causes the S&P to break below the 56 to 5,700 level post-election, then we are looking for heightened volatility and less supportive flows overall. We could quickly enter negative feedback loops due to heavy put buying. For the bullish case, if the election goes relatively smoothly and prices remain stable above 5,700, then we should see a big drop in the VIX and implied volatility, and we would look for the S&P 500 to reach 6,000 to 6,050 by the year end. And so with that, let's look forward to our election playbook and volatility and positioning ahead of the November 5th election. So what are we watching ahead of the election? Number one, market volatility. What does implied volatility? We'll refer to that as IV or vol. What is that showing us ahead of the election, and how does that translate to the market's overall expectations of price movement? Options prices infer how much underlying stocks can move, and that is what we're going to break down. Second, positioning. How are market participants gearing up for the election? Where are large players entering or exiting positions? We'll give you a hint right now. They're hedging their tails. And then the last thing is the key sectors to watch. Which areas of the market are most impacted by those upcoming elections? So first, we're going to start with volatility. How much movement does the market expect? I want to start this with bringing up TrendSpider. This is the S&P 500, and what is interesting about it is we are just a fraction off of all-time highs that were reached at the start of October, right around 5750 in the SPX. And so overall, you have to say this is a market that is not terribly concerned about risk when you consider that we are at these all-time highs. However, you can juxtapose that versus the VIX, and the VIX is quite elevated. And what's interesting about this is that the VIX measures S&P 500 options that are 30 days to expiration. So today is Tuesday, October 8th, when we were recording this. And so it is just in the last few days here that the VIX has started to price in the upcoming November election. And so the VIX is now at 2145, which is really quite elevated considering the fact that the S&P itself is at all-time highs. We can frame this a pretty interesting way. I want to show you what's called realized or historical volatility just to set the stage. So if we scroll down here, this is the Spotgamma platform. We're going to open this chart up, which is called realized volatility. And what I want to show you all is 1 month realized vol. What does this mean? Well, the barometer of how much volatility we should expect in the future is essentially how much volatility we've had in the recent past. And so what you see here is on a rolling 1 month basis, our current implied volatility level is just 9.7. And so that tells us that we're getting roughly 40 to 50 basis point moves daily in the S&P. It's not a lot of volatility, right? 0.5% roughly. And so you can compare this directly to the VIX and you say, okay, 1 month realized vol is at 9.7. Let's just call it 10. But the VIX, as we just saw here, TrendSpider is 21. So that extra 10 points is a lot of that is related to the election and some of the other risks that we have. So the market is indeed bracing for impact with this upcoming election. I want to show you the way that people are really pricing this upcoming election period using some of our volatility tools. The interesting thing here is we want to start with this idea of term structure. Now, term structure shows us for each expiration day, and there's an expiration every single day in the S&P 500, what is the implied volatility associated with that expiration? Essentially, how much movement do traders see? And what you'll notice on this chart is it's fairly low in average as I draw my line across here until the election. So you see this big bump. So this is telling us that indeed there's a fair amount of hedging for the election. In fact, if you compare the volatility level before and after, you see it goes from about 13.5 up to about 16.4. Now, there's this very interesting rule of 16, it's called. And what you do is you just divide this number, 16.4 by 16, and you come out with what traders expect is the daily move for the S&P 500. So what does that tell us? That right now traders are expecting only about 1% moves out of the election, which isn't huge, but it is larger than we've seen in previous elections. The other thing that's interesting here is if we flip back to TrendSpider, we can start to see where traders are starting to look or hedge themselves out. And one of the fascinating ways to do this is if you look at the VVIX. What the VVIX tells us or shows us is how expensive are essentially out of the money VIX calls. And as you can see here, they're quite elevated. This was the big August sell-off around the yen collapse, and then we had a little bit of volatility in September. And we're indeed higher again in this VVIX metrics, which tells us that there's demand for upside calls. We'll be touching on that again in a minute. Another way to frame this is through what's called skew. Skew shows us the implied volatility for all options in a certain expiration. And so this expiration we're looking at is 11/7. So this is 2 days, the expiration for 2 days after the election. So it's 1 month skew is what we'll call it. And the shaded cone is the 90-day range. And so what you can very clearly see is that across the board, we can say this is call options and these are puts down here. So across the board, what we're seeing is very elevated volatility, particularly for these really far downside strikes. And this relates to an interesting positioning concept, which we'll touch on momentarily, that tells us that, look, traders are hedging their tails right now. And this has not only to do with the upcoming election, but also geopolitical uncertainty. So just to summarize this again, what we have here when we look at the VIX space is a very elevated VIX. We have a lot of demand for downside puts, tail risk in the S&P. We have demand for upside calls in the VIX. And we are currently pricing in about 1% moves for the post-election period. I would expect as we get closer to the election, the volatility that traders are pricing in starts to increase. So as I mentioned before, we have roughly 1% daily moves is what the market's pricing in with a 17% implied vol. I would expect that number to increase as we get closer to the election and more traders start to hedge the event itself. So that is a look at the volatility landscape. Again, traders expecting 1% daily moves, but there is a lot more tail hedging and people watching for sharp downside. So before we move on away from the equity vol space, I mentioned that we're seeing a lot of elevated volatility across other asset classes. And that's always a concern for us because, something like the butterfly effect, if you get a lot of volatility in rates or commodities, that can make its way into the equity complex. And so to frame this up, I want to show our founder's note from today. This is October 8th. And if I scroll down, there's this interesting chart from the SIBO. And what this is showing us is cross-asset volatility for all of these different assets. And what you can see here is, yes, the red line equity vol is spiking, but we also have vol spiking in oil due to the Middle East situation, as well as rates. Those of you who are familiar with the MOVE index, that index has gone from roughly 100, 105 right after the FOMC a few weeks ago. It's now up at 124. So that's telling us that there's a lot of volatility in that space, which is always concerning for assets. And then lastly, you can see FX vol right here, related again to the shifting rates, the yen and all of those other things. You can see that rate vol is jumping as well. So not only do we have this hedging into the election in the equity space, we have rates moving higher. The 10-year just broke 4%. So that's causing a lot of volatility and hedging in that area, as well as some of those aforementioned commodities. So this is a very volatile environment. Even if the election wasn't here, you would have quite a high volatility environment, which is always concerning for stability, for the stability of equity prices. So with that, let's move to the next section here. We want to talk about positioning and where are traders looking to enter or exit the market. Now, the big thing I want to start with is this skew index, because this helps to frame things rather nicely. What the skew index measures is the prices of out-of-the-money puts relative to at-the-money puts. So essentially, how expensive is tail risk protection? And what you can see here is that it's really relatively high. It's almost at all-time highs in this index, at least going back here to the mid-2000 teens. And what this is driven by is demand for fairly out-of-the-money puts, as I just mentioned. So For example, today we saw somebody buying a bunch of 4,700 puts for mid-November, and that is the target zone, that kind of just sub 5,000 area, call it 10% out of the money to 20% out of the money. That's what traders are looking for to hedge. Where does this leave us in terms of positioning? Well, for that, I want to look at what we call gamma by strike, and this is again on the Spotgamma platform. And what you're seeing here is two sets of lines. You're seeing orange, which is call gamma, and blue is put gamma, and this is buy strike. So we sum the gamma for every strike using open interest. And the reason we do this, the reason that we weigh things by gamma by strike as opposed to open interest, is because gamma tells us how much hedging flow is associated with various positions. And so you can see here, generally speaking, this is the 5,700 level where we're currently trading. What you're generally seeing is through, call it 5,600 here, it's pretty balanced. What do I mean by that? Call positions and put positions are roughly equal. And when the market is in these regions, when the S&P is in these regions, we have stability of prices. Why is that? Because dealers and market makers, as they hedge, they buy the dip, right? So if the market starts to get weak, they start to buy futures or buy stocks, and that supports the market. Secondarily, if the market starts to rally, they start to sell shares or sell futures into that rally. And the net effect of that is that volatility collapses or contracts, right? We get a very stable market that tends to kind of drift higher. What I want you to notice here is under 5,600, which is right here, put positions pick up versus calls in a major way. So this is all the tail risk hedging we just mentioned in the kind of 4,700 area. But you really see those positions turn to net put positions in this general zone. When you get that situation, what happens is if the S&P breaks 5,600, then you're going to start to see market makers, instead of buying futures and stocks into dips, they start to sell them. And that could really speed up how quickly the market moves to the downside. So that's where we would expect to see, say, the VIX move significantly, 40 plus. That's where you'd see the S&P start dropping, 2% a day. That's where risk really rears its ugly head. So we think it's very important for traders to be watching this level because that is where market maker hedging flows will really start to push that market lower. It's also an interesting place because when you think about elections or just events in general, you can get a lot of short-term volatility as traders are reacting to headlines, right? Okay, one candidate has another lead over another candidate, and the market will jump down to that or jump up versus that. It looks like one country may retaliate against another here. You'll see the markets kind of jerk or respond to that. But the move tends to mean revert, right? The headline gets faded. In this case, we think headlines are generally apt to be faded until we break 5,600. If we break 5,600, then we're going to know that the selling, or we're going to really feel strongly that the selling is real, and then we would be looking for sharply lower markets. The next thing in terms of positioning to look at is back at these skew metrics. So I wanted to pop back because we alluded to this just earlier, that traders were indeed hedging or buying those out of the money options. And you can really see that here in the options pricing. The shaded cone is, again, 90-day average. So this is the 90-day average of 1 month skew. And you can see that there's this separation in here. And what that separation is telling us is that there is arguably excessive demand or extremely elevated demand for these out-of-the-money puts. And so that is really the big takeaway here, is that traders are indeed buying a lot of these out-of-the-money puts. The other place that you can see it is if we go and look at the VIX. And the VIX is interesting, obviously, because that is a great way to hedge of a very volatile event. And in this case, what you can see is that particularly it's this 35 to 40 strike calls, particularly if you start to look more on time, you'll see this. But statistically, these are being driven very high, and this ties into the elevated VVIX that we just mentioned. This is not like nosebleed, unbelievable levels of prices for VIX calls, but they are starting to elevate. And as we mentioned before, we think that these volatility levels, in other words, options prices, are going to start to increase as we get closer to the election and demand for hedges start to pick up. That pretty much covers how traders are positioned here. There is absolutely some tail risk hedging but traders don't yet appear to be reducing longs, as we can see by the fact that the S&P is again near all-time highs. So the tail risk hedging has come in, and it is not only related to the election, but some of these other events that we have. Okay, so what assets are most likely to be impacted by this election? We really have two key views here, and it's driven by the options positioning. It is that options positioning when it shifts that could really move some of these underlying stocks. The first thing we want to talk about is just the equity market writ large due to the options positioning in this elevated implied volatility. A lot of the banks are targeting, and you'll hear pundits out there targeting the S&P 6,000 level, which is this strike right here, as an end-of-year target. As you can see here in gold, there are tremendous call positions up at that strike, which we think does make it a big target into end of year. And we would also highlight this one right here. This is the 6,055 level. This is where a well-known trade called the JP Morgan collar strike is positioned, and it's positioned for 12/31 expiration. And so if we get the market to rally here, that will be a big magnet for end of year positioning. So for that reason, we really like the 6,000 to 6,055 area as an upside target for the S&P 500. Now, why are we leaning on a market rally out of the election? It's because of this idea of implied volatility being very elevated. And if the election is clear, regardless of who wins, if the election is just results that we can all believe in, and it happens in a fairly short time frame, that certainty traders really like, right? Doesn't matter necessarily which candidate I have, just tell me who the candidate is so I can make my investment decisions. If that happens, then what is likely to happen? Well, number one, the VIX and implied volatility is likely to start to drop sharply. And this ties into this idea of Vanna. So I want to show you this model because it helps us to frame this. In this case, we have the S&P 500 price on the x-axis, and on the y-axis here, we have what's called delta notional. So this is roughly how much, in dollar value terms, how much dollars have to be used to hedge out the S&P 500 options positions. So generally speaking, when the market goes down, dealers and market makers have larger notional exposure. Why is that? It's because they're short put options. So the market goes down and you're short puts, you essentially have more long exposure to the market, right? Because the puts are going against you and you need a market rally. So what do you do in that situation? Well, you sell more futures as the market goes down, and that offsets the exposure you have. So let's write this out. So if here we're flat, I'll have to sell, $1 million here, and then $2 million here, and then $3 million here, and so on, right? To maintain my exposure. Well, it works the other way too, right? So let's just say that we're sitting here and the election results come out. What happens? They're clear. There's a clear winner. VIX is going to drop. So the VIX is going to do something like go from 22 down to 15. And what that does is it crushes put values, right? Because those put options, there's so much tail hedging right now that those put prices are very expensive. They require a lot of hedging flow. When that implied vol comes down and like the VIX drops, those put values get crushed. The equity market does not even have to move for that, right? It's just that vol coming down. It crushes those puts. And so all those millions of dollars that we were talking about hedging shorts can all get bought back. And so the result is say roughly, rather than needing $30 billion to hedge yourself on a rally in the market, you're only going to need maybe something like $29 billion. And this is a very short-term metric that we're looking at here, but it frames the idea, right? That the decline in implied volatility means that dealers and market makers need less short hedges so they can buy that back. And that can be extremely powerful. That can drive really sharp rallies in the market. Let's frame this a little bit. If you look back over the last 1 to 2 months or so, what you'll see is a couple of extreme volatility events. Number one, we had the VIX print over 60, right? So VIX 65 in this area. And then we had another volatility kind of spike right around September 11th. And you'll notice how quickly both of these moves mean reverted. We believe this is in a large part due to traders coming out and shorting high volatility levels. What does that mean? They come out and they sell put options or they short the VIX. They do those types of trades And that helps to rally the market very sharply because it creates buying flow for dealers and market makers. And so in this situation, while we're sitting here, we're waiting for the election results to come out. If the election results are clean, again, that could create this buying impulse that could really push the market higher just on the back of this flow and positional analysis that we have just conducted. And so again, we're really watching that 6,000 level, which is a pretty healthy 5 to 10% rally in the S&P 500. There's one other name that really catches our eye in relation to the election. And it's very clean and simple to, we think, run this analysis. So what are some of the other sectors that traders are looking at? The cloudy picture here is due to the rate and geopolitical situation. If you look at like the energy space, it has had a fair amount of volatility. Volatility levels, as you can see here, they're all askew. They're kind of a mess because of the geopolitical. They're kind of a mess right now because, and they're really tied more to geopolitics, we think, than elections. The second thing is obviously the rate complex. We mentioned that before. So if we look at something like TLT skew, you can see that where there is a bump related to the election. As you can see here, this is suggesting that bond prices are tied into which candidate's going to win. But there's also just a lot of vol, generally speaking, because of the fact that, for example, the 10-year has just broken 4%. So that's very clouded, and we think that there are other exogenous factors besides the election. The stock that is the most interesting election-related name, however, is Tesla. It's no secret that Elon Musk is really dialed in or tied to the Trump campaign at this point. In fact, in a recent interview, he said, if Trump doesn't win, he's in trouble. I'll put it that way. And Tesla has had a tremendous rally over the last couple of weeks and months, as you can see here. And as we sit here on the 8th, they are going to announce robo-taxis. They're going to give us a robo-taxi update on the 10th. And if you look at the volatility positioning in Tesla, what you see is that there is the robo-taxi issue here, and then you have the upcoming earnings on 10/25. So those are both very big events. If those turn out to be bullish, then we could have a situation where Tesla is really starting to prime and could be very easily testing this 250 to 260 area. Why do I think that? Well, let's look at our equity hub positioning, and I'll show you where the big option strikes are. So in this case, just in how we were looking at put and call positions in the S&P, orange is call positions, blue is puts. You can see there's a ton of positions here at 250. We think that is a very near-term magnet. So into the robotaxi and earnings events, that 250 to 260 area is very big. You'll notice there's a bunch of positions here at 270, and then we see 300. I think that if Trump wins the election, we're very quickly going to see Tesla rip. And if the robotaxi event is good and if their earnings are okay, that move, right, or Trump kind of maybe resetting Elon's relationship with the federal government in some respects could be extremely bullish for Tesla, and it could really reestablish it as one of the top stocks in the S&P 500. I wanted to show you the implied volatility positioning here. You can see from a 1 month basis, what we see is what's called a mild call skew. What does that mean? Well, if you look at the at-the-money options, Tesla's currently trading here, and you look at these upside strikes, they have a higher implied volatility level than the at-the-money. So this is telling us that there is a lot of call demand for Tesla into the robotaxi event, and then this could continue into the election period. If we zoom out a little bit more and just look at end-of-year positions, or in the volatility space. So I want to check the January expiration in this case. What you're going to see is that the positioning is much more neutral. So in this case, you see there's a little bit of a call skew. It's pretty flat, but the options are not really very elevated. And so what we think is going to happen is if Trump does win the election, we do think that that's really going to benefit Tesla more than anything else. Tesla is a name that a lot of options call buyers like to come out and charge into that name. And so we think that this could really lead to Tesla looking up at this 300 level. Now, the flip side of this coin, obviously, is if the robotaxi event is not all that inspiring and the earnings aren't that great, and then if Trump doesn't win the election, well, then you have to really start looking at the opposite end here to start looking at that 200 level. We think after the election. So uh, Tesla, we would argue, if Trump wins, very bullish for that position, and with all those calls struck at 300, we think that could be a real magnet for that stock. So that about wraps up which assets are likely to be most impacted by this election. Again, we think equity markets writ large with any type of a clean election, we could really see a rally. And then the second side of that equation is Tesla, which if Trump wins, it could be a real major event for Tesla. So with that, we want to thank you very much for watching our election preview here. If you have any questions, please come over to visit us at spotgamma.com. We run a proprietary options analysis every single day and have been doing so since January of 2020. We have a bunch of amazing tools that allow you to understand how the options market is moving the underlying market. And if you should have any questions, email info@spotgamma.com or check us out at Spotgamma on X.
We're joined today by Mr. John Bollinger. He's here to give us his thoughts on the market heading into the elections and some key signals that we need to be mindful of and monitoring as the elections hit and then in the months that follow. John, I'm going to turn it over to you. Thank you so much for being with us.
Thanks for spending some time with me today, Jason. I know that the election's on everybody's mind, but I don't think that the market's really too concerned about the election right now. I think the market's probably more focused on the economy and what path the Fed is going to take. But I brought along sort of the basic TrendSpider workspace that I use to look at stocks and indices and such like that, and a small list of indices, starting with the S&P and running down to a couple of equal weighted indices. And my point here is pretty simple. This market's pretty strong, and it's staying strong. So what we see here is a chart of SPY. Again, I much prefer looking at the tradables rather than the indices. And I have daily and weekly Bollinger Bands on here. This was the feature that first got me interested in TrendSpider, this multi-time frame analysis on one chart. I find it a huge time saver when I'm trying to run through a lot of ideas. So here you see the SPY. It's the S&P 500 ETF making a new high and really nicely confirmed by %B. That's that middle clip in the screen, middle of the screen there. You can see a series of higher lows in both the daily and weekly versions. And, this is just a very strong market that's well confirmed.
Yeah, what's your perspective on that? Why does the market not care? It's just simply all about interest rates. Do you think that the market will start caring at any point?
I think it probably will start carrying, maybe closer to the election. I think the fact that the polls are so tight is part of the reason the market really can't figure out where the advantage is. That's just a guess. Normally, I like to look at the betting results. Interactive Brokers is currently running betting on the elections, and there's numerous other sources. Over the years, those market-oriented views of election results have proved to be very accurate and very useful. But they're virtually a push. Depending on which series you're looking at, one might have a tiny edge over the other. But there's no clear advantage. Meanwhile, I think that there was a lot of worry about the economy. And the market's much more concerned about that. And sort of as a secondary thing in that worry about the economy, they're really focusing on the Fed. But let's just step down and look at a couple of these charts. This is SPY, so this is large cap. This next one is MDY. It's the S&P 400, and it is mid cap, and you can see it is out to a new high as well, and shows exactly the same pattern that we're seeing in the S&P 500, higher highs and higher lows, both in absolute terms and in relation to the Bollinger Bands, and I really like structures like that. So as you get down in cap size here, we get to a much tougher chart. It's still a good-looking chart, but it has not been able to break to a new high. This is the S&P, the ETF based on the S&P 600 small caps, and we look at a similar situation if we go down to the microcap ETF, but it's even more range bound. So people are making bets on the big companies that they know and understand. The top 1,000 companies are covered by the S&P, SPY, and MDY, but you get down into small stuff, and people just there's more uncertainty there, and they're not really marking them up. I also like really to look at these equal weighted ETFs. This is the S&P 500 equal weighted ETF. Everybody's been super concerned about, only 3 stocks are driving this, or only 2 stocks, or 5 stocks. You pick your number, whatever the worry is. But I don't think that it's that big a problem, honestly. Here's a equal weighted S&P 500 ETF, and you can see that all 500 stocks are pulling in one way or another here. They may not all be making new highs together, of course they're not, but there's no divergences here between this and the cap weighted version. When you get those divergences, that's a big worry. And then you zoom out a little bit. This is the Russell 3000, the top 3,000 stocks in the market. It's at new highs and a very similar pattern. And then finally, I really love this. I love this. It's probably my primary market tool. If I just want to find out what's going on in one shot, I come here to the Invesco Russell 1000 equal weighted index. So this is an equal weighted index of the top 1,000 stocks in the market. NVIDIA is not driving this, right? The average stock is driving this, and you can see it's a very constructive pattern.
One thing that I notice across all of these charts, at least on the daily, the bands are tighter than they've been in months. You got to look back to like June or July to see the bands as tight as they are right now. What is your read on kind of that setup?
So we call that a squeeze, or we're approaching a squeeze. Going back to SPY, you can see a really low level here. But if you look at the weeklies, it's nowhere near as low on an absolute basis, but it is as low on a relative basis. So generally these periods of compression like this lead to some form of release, and most people like to think that it's a forecast for prices to move lower, but in this case it's forecast for prices to move higher. And you can see it as you flip through these guys. It's the same for all of them. There's a lot of compression, and we're just breaking out of the upper band for all but the 2 smallest of even the equal weighted ones are breaking out of the upper band. So the big question, of course, on everybody's mind, we're investment managers. We're classic RIAs, and when the small caps and the mid cap and the mid caps go, they really go. So that I think the big question is for everybody is when participation is going to broaden out. And in terms of the election, is that something that's more likely to happen under Harris or happen under Trump? I have no forecast in that regard.
What visual cues should traders be looking for on those charts using Bollinger Bands to identify that they are kind of making that move that you're looking for and that move is like sticking?
So let's go back to SPY. So we call this a walk up the upper band, and it's pretty well confirmed. You can see it's walking up both the daily and the weekly upper band. So until you see some separation from that, we would, in technical terms, we call that a type of divergence. Until you see some separation, prices can and do walk up the upper band for extended periods,
Right.
and there's no sign of separation yet. So, if you look down a little bit further, the equal weight here is doing exactly the same thing, and the Russell 3000 here is doing exactly the same thing. So the support is very broad here.
How exactly do you define separation?
Oh, literally just price separating from the upper band. You can
Got it.
see that we're actually out above the upper band. When you can you see my pointer here?
Yep.
Oh, okay. So, right now, percent B, which tells us where we are in relation to the Bollinger Bands, is well above one, which tells us that we're trading above the upper band. And you can see that, back here, we tried to break out and failed, just pulled back to the middle band. That's a very normal bit of activity, right? You get a little bit ahead of yourself, and prices consolidate and pull back toward the middle band, such like that, and then start back up again. That's very bullish activity. So separation would look like you run up here a little bit, and the band expands even higher, and you find percent B down here. Messing around with 0.5 or 0.6 or something like that. That would be the first alert, and then you would want to start paying a lot more attention.
Okay. Gotcha. Is there any significance to when your lower time frame band eclipses your higher time frame band, kind of like we saw in maybe late July, kind of late August?
Oh, that's a great question, Jason. I don't know. I'll have to study that.
Okay, right on.
You
Just curious.
there's a whole bunch of people that use Bollinger Bands and Keltner bands together,
Right.
or Keltner channels, they like to call them. And when the Bollinger Bands are inside the Keltner channels, it's that sort of situation that we're in now, where you have a squeeze and it's a forecast for higher volatility.
Right.
So the relationship of bands with other types of bands is an area that's proved to have a lot of value in the past, but I've never really studied that particular aspect. I will be looking at that.
Yeah, that would be interesting to know. Maybe we could go through some of your market timing charts.
Okay, so each week I produce something called the market timing chart pack, and it's 50 classic market timing tools. Some of them you'll be familiar with, some of them you probably won't be familiar with, but I post it on my website each week, usually on a Saturday or sometimes on a Sunday, and it's free. You can just download it and flip through the charts and get a feel for what's going on out here. I'm going to skip a lot of charts because there's 50 of them. We don't have all day to explore. But this first one is exactly the same chart that we were just looking at. Is the S&P 500 with percent B beneath it, and you can see that there's no divergence whatsoever. And today, with us breaking the upper band, it will actually, percent B will be at a new high with price confirming. So, and here's that situation you were asking about. The bottom clip is bandwidth, which tells us how wide the bands are, and you can see at 3.48, that's very narrow for the S&P 500.
Right.
Basically, anything under 5 is pretty narrow, and the further you get down there, the greater the compression is, and I think the greater the release. And currently, we're seeing compression and release to the upside. Now, this is a little bit of an esoteric chart, but I put it here because I wanted you to look just at one little aspect of it. If you Can you see my pointer here?
I sure can.
So this blue line right here is called on balance volume. It's a market timing tool created by Joe Granville, and each day it either adds volume or subtracts volume based on whether price is higher or lower. And you can see that for the past month, it's just been chopping sideways, and we've been up and down, 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 and that's a very unusual pattern. There's actually a technical indicator designed to show that. It's E.W. Dreise's choppiness index, but this tells me the degree of uncertainty that's out there. People don't know what the election result is going to be. People don't know how the economy is going to behave. People don't know what the path of interest rates are going to be, and they're battling it out in the marketplace every day. So that's when you get this alternation of up and down days like that.
Right. Interesting.
Yeah. I thought it was super interesting. When I saw this chart this weekend, I went, aha, that's exactly what I've been feeling, and that really confirms it. So this is the VIX in the lower clip here. It's running a little higher than I think it should be given the strength of the market, and I think that's basically people making bets on the downside and/or buying insurance. So I think it's a reflection of the sort of uncertainty we're seeing in the market.
Why do you think it's running hot? Just out of curiosity.
I think it's people buying puts. Honestly, I think it's just that simple. The put side of the equation is really what drives the VIX, and I think that there's a lot of put activity out there. And one can't ignore the fact that there's a huge amount of this zero DTE, 0 day to expiration trading in the options market these days, and so many of these indicators that are based on option premiums and option trading are stressed. So that could be part of the problem too.
Are there any particular signs with VIX that you would be looking for? Warning shots, I guess, or like what would perk your ears up if you saw happen on the VIX?
I don't know. If the VIX got down to 10 to 12, I would get really nervous. I think that's the biggest takeaway, because that would mean real complacency. That would mean really everybody had bought into the bull market scenario, and with the election coming up, the election's going to be a focus point. So if we were to arrive into election day with a very low VIX, I would be very cautious.
Interesting. Okay, we'll have to be keeping a close eye on that here over the next month and a half, huh?
Yeah, I'm going to skip a couple charts here and go to this one. This is the advanced decline line for the S&P 500. It's not usually we look at it for the New York Stock Exchange, but this is for the S&P 500, and you can see it's confirming the strength that you're seeing in price. And then we already looked at this. This is the lower clip is RSP. That's that equal weight version of the S&P 500. You asked about this before, so this is a great way to see this by plotting them both together. If they have the same pattern, then everything's fine. If they have different patterns, then it's a big alert, especially if RSP is falling off while the S&P 500 is climbing.
Yeah, that makes a lot of sense too.
Yeah. So you kind of saw that in here coming into this decline. You had the S&P rolling and RSP going sideways, right? Mm-hmm. So it just tells you that there's some internal weakness in the market. So this is just growth versus value. People favoring growth here. This is consumer discretion versus staples. Again, all of this is based on tradables. Everything in there is that can be is based on tradables. So people are really starting to believe in the consumer here and better outlook for the economy. I'm going to skip these because those are a couple that are pretty hard to explain in the short term. But this is a really interesting chart. So this is some work by the late great Jim Alfier, he did this thing where he, in different time frames, he counted the number of up days versus the total number of days. So that orange, I'm sorry, the fuchsia line is the longer term indicator, and the blue line is the shorter term indicator. So the fuchsia line tells us that the market's been steadily overbought for quite a while and progressing, and then you see the shorter term activity swing around that, and that's exactly what you expect in a bull market. You expect that intermediate to long term of bull markets, going to stay fairly overbought, and that short term you're going to get some noise around that. You're going to get some pullbacks and such, so you know what to do.
Interesting. I've never seen this chart before.
Yeah. The original paper appeared in Barron's maybe 40 years ago. He called it urgent selling, and they followed it up 2 years later with another paper called prolonged selling, which is a longer term version of it. And then we've combined them into this, and we look at both the buying and selling sides. Jim was only concerned with the selling side, because he was primarily interested in playing defense. So
sorry. Do you have any concern with the negative divergence that you're seeing on that shorter term chart? Lower highs versus higher highs on the index there?
No, it's what we expect to see. It just I would expect what would get my attention here would be if both would start to roll off.
Got it. Okay.
So New York Stock Exchange advanced decline line, confirming price, no divergences there. These are a couple of breadth oscillators. They measure the activity of advances and declines versus up and down volume. Dead neutral here. They're neither overbought nor oversold. Can't explain that in short term. RSI here, very interesting. There's a lot of work been done on RSI in terms of the ranges it's trading in, as a forecast for whether we're in a bull market or bear market. So you see 3 sets of lines here instead of the classic 2 sets of lines. Normally, you would only look at the 30 and 70, and you just automatically say 70 was overbought, 30 was oversold. But we've added 20 and 40 and 60 and 80 because in a bull market, right, 40 and 80 become the proper references, and in a bear market, 60 and 20 become the proper references. And if you just look at what ranges we're trading in, that'll tell you whether we're in a bull market or bear market. So clearly here, over the past year, we've been in the upper portion of this range. We've only been under 40 twice. Most of the time, we've been over 60. So that's clearly bull market behavior.
Fascinating. Never heard that before.
Yeah, there's a wonderful guy. I'm spacing his name right now. He passed away about 2 years ago. Who was the primary driver of this type of analysis? Wow, just can't remember his name. It'll come to me.
Yeah, that's all right.
MACD turning up from a high level, that's always pretty bullish. It takes a lot of market strength to turn MACD up from a high level. This is the McClellan oscillator. It dipped into negative territory here, but the best tool here is the McClellan summation index, and here we use Jim Mika's calculation, and this is just very strong up here in the 1600 area. That's again, you only get there in bull markets. It's
why is this the best tool to use?
Because this is just the McClellan oscillator, which the summation index is based on, is just a much shorter term tool. It's a much noisier tool, and one that you really have to pay a lot of attention to use properly. But the summation is it's a much simpler tool. At very high levels of it are very bullish.
Got it.
So it's just easier to use, but there's a lot of value in the original McClellan oscillator itself. So Greg Morris wrote a pretty interesting book on market timing indicators and such like that. And the bottom line from his analysis was that this was his favorite. This was his number one choice. So you see new highs and new lows here. We're running, a surplus of new highs. That's exactly what you'd expect to see. So this is a really interesting index. This is one of the oldest broad market indicators around, developed by Abe Cohen of Chartcraft fame, probably in the 1940s or so. It's a ratio of the number of stocks making new highs to the number of stocks making new highs plus the number of stocks making new lows. So running up here in the 85% range, it's just very strong. It's showing no signs of divergence here.
Would we be watching a break below that moving average?
Yeah, and more importantly, a pullback which drove it below 30 would really be and you can see in both of the prior pullbacks this year, it remained well above 30, but the more troubling pullback in October of last year, it actually was able to get below 30.
Yeah. I mean, just from this chart, those look like excellent buying opportunities below 30.
Yeah. Let's see. Let's just skip it. We don't have all day here. So let's skip a couple of these. Bullish percent. This is another older technical tool, again developed by Abe Cohen at Chartcraft. Those were the people who brought you the 3-point method of point and figure, and they had a subdivision called Investors Intelligence, and produced a lot of surveys and such like that. We'll get to one in a minute, but this is simply the percentage of stocks that are on point and figure buy signals. So at 61, 62, which is where we are now, that's very strong. So it tells you that the participation in the market is very good.
Can you give us a brief explanation of point and figure?
Can I do heart surgery? And yeah, point and figure is really an elegant approach to charting. It ignores time. It just focuses purely on price. And when price is rising, you put a column of X's going up the piece of paper that you're charting on. And when price starts to fall, you put a column of O's. So a point and figure buy signal is when a column of X's exceeds the prior column of X's. So it just means that price has made a new high relative to its prior high.
Got it. Okay.
It's a shorthand form of charting. Comes from back in the day when maybe the late 1800s, early 1900s, when people who were traders on the floor, or before there was a floor, outdoor traders would mark just the figures, the point, aka 10 point, and the figure a quarter, right? They would mark the point and figure on a little piece of paper in their hand, right, to keep track of where price had been, because maybe they were making markets in 10 or 15 different items, and they just flip between the cards and see what they needed to do when an order came in.
Got it. Okay. Cool.
So,
That's what I thought.
yeah. Point and figure, right? The 10 today we don't, it would be 10 point, and a decimal, but back in the days it was eighths and quarters and halves and such like that.
Right.
This is a little hard to see chart, but it's the way I like to look at it. This is the AAII, the American Association of Individual Investors. This is their sentiment survey. They do it once a week on Tuesdays. The green bars are the percent of people who are bullish. The red bars are the percentage of people who are bearish, and the black line is the net of those two.
Mm-hmm.
Right, and then a little moving average. So, that what this says right now is the typical investor here is bullish, but not crazily so.
Yeah.
And this is the same thing we talked about. Abe Cohen's Investors Intelligence. This is a survey of investment advisors. In fact, it used to be purely market letter writers back in the days when market letters were the primary way of distributing stock market opinion. So again, the green bars are the number of writers that are bullish. The red bars are the percentage of writers that are bearish, and the black line is the net. So at 30, again, it's bullish, but not ridiculously so.
Yeah, cautious almost.
Yeah. Well, here's caution for you if you want.
Okay.
Here's caution. So this is named. This is a group of active market timers, professional investors. It's a National Association of Active Investment Managers. There we go. And every Thursday they publish the percentage of the percentage that, on average, that their members have committed to stocks. So currently they're 90% invested, and it runs from 0 to 200. Actually, it could theoretically go negative. I've never seen it go negative. Were they to be net short.
Mm-hmm.
But again, this is a very, very strong market, and they're sitting there at 70, 80, 90% invested. That goes back to what we're talking about with the VIX and all of that. I think there's an overabundance of caution in the market, which is a good thing for stock prices.
Would you consider this kind of like under invested, or is it just kind of moderately so?
For them, it's under invested.
Okay.
On a relative scale, but they'll go to 150. I mean, they're active investment managers, so they'll employ leverage.
Right.
So I think that given how strong the market is, this is underinvested. Obviously, for your typical person, this is very invested. But these are professional market timers. Right?
Yeah, that really have to be invested at all times in some way, shape, or form.
Yeah.
Interesting.
Exactly.
Interesting.
So I'm actually going to skip these next 3 slides because these are all based on put and call activity. And I think they've just been hopelessly distorted by all the zero DTE trading.
Mm.
And we need to work out a new set of indicators here that'll help us. But that it just just noise right now as far as I can figure out. And I've been working hard on trying to figure out how to create some new option indicators. But I haven't solved that problem yet. So this is a proprietary thing that I do. This is the how to explain it. So we have inverse ETFs, right? And there's a lot of interest in them. So this depicts the volume in inverse ETFs on a relative basis. So when nobody cares at all about inverse ETFs, it'll be down around 100. And when they're buying the inverse ETFs like Armageddon is upon us, it'll be 300, 400.
Got it.
So for some reason, I've never figured out. It seems to have settled out at about 200 on average. So I should actually just do a relative calculation, set that 200 to 100, and it make it easier to interpret. But this is what it is. So again, this is way more inverse activity than you would expect, given the strength of the market.
Right. So signals really at the fringes.
Yeah. So this is the next bit is the dollar, and so some other stuff. But this I think is pretty interesting. So we do Norgate data. Calculates advanced decline numbers for many of the indices. We saw it before for the S&P 500. So here it is for the Russell 1000, and you can see that the advanced decline data here is quite strong for the Russell 1000. And then beneath that, in the red and the green and red, green is the number of stocks making new 52-week highs, and red is the number of stocks making new 52-week lows. So last Friday, 132 stocks in the Russell 1000 made new 52-week highs, and none made new 52-week lows. Again, pretty on balance.
Yeah.
And we repeat that for several indicators. For several different indices, but I think this one is particularly telling because this addresses a lot of people's concerns. This is the NASDAQ 100, and you can see it's quite strong. The 80 line is quite strong in new highs and new lows, but this is the NASDAQ composite. So it's got all the smaller stocks in it, and it's in much worse condition. So people just aren't, there's just not belief in small cap stocks. And I think, again, that's a function of uncertainty.
Does that surprise you, though, with the outlook on interest rates?
No.
Do you have any opinions about interest rates?
I think interest rates are going to continue to go lower. I think the Fed correctly understands that it's short-term interest rates are above equilibrium, and they're going to pull them back to equilibrium. I don't believe that the Fed is loosening here, particularly. I think it's trying to get back to equilibrium so they can get back into balance and resume normal operations instead of having to fight either deflation or inflation.
Yeah, right.
But that's just opinion. What we pay attention to is the price of stocks.
Of course.
There's a NASDAQ volatility index running in 23, 24 here. Again, that's pretty high for it given the strength of the market. Same comments as before. So this is a very hard to read chart, but it's one of my favorites. This is the relative performance of the market sector ETFs plus a couple of other items. So they're colored by the 1 week change. So transportation were the strongest one last week.
Right.
And utilities were the weakest one last week's. And then they're arranged up and down on this grid by the 1 month rate of change. And they're arranged left to right by the 6 month rate of change. So most of everything is sitting up here in the upper right hand quadrant, which means that they've been going up, and you can see that there's a few that are having a little trouble. Real estate, health, biotech, consumer staples are underperforming, but the core of the market is in there: industrials, tech, finance, large cap, consumer discretionary, transports. They're all sitting there. So that's a pretty healthy picture.
Are there any scenarios that you would be particularly watching for here? Certain sectors kind of making a sharp move in one direction or another?
So these guys rotate through this space here.
Yeah.
In a bear market, you'll find them all cowering in the lower left. In a real giant bull market, they're all clustered in the upper right, and they rotate through it. So you're starting to see a little bit of that rotation here. You've got a few that are dropping down, but nothing is really moving right to left. That's what would really worry me.
Got it. Okay. That makes sense.
So these are commodity prices. I think they're pretty important here. The black line there is an equal weighted commodity index that I calculate. It's got 19 commodities, and it's been strong here. And I think that's a reason for concern on the part of the Fed. Commodity prices being as strong as they have been. So I would use this to argue that the next cut's going to be limited to a quarter point.
And that seems to be becoming more and more consensus.
Yeah, and in this case, I think the consensus is pretty good. So this wants a long explanation, which we don't have time for, but suffice it to say, this is the way the Dow Jones Industrial Average was calculated prior to 1982. We call it the theoretical Dow. It's all the highs of all 30 stocks are used to calculate the high of the average. The lows of all 30 stocks are used to calculate the low of the average and close. Because prior to 1982, we didn't have any real-time data, so there was real-time calculation of the averages. But it actually proves to be very, very handy because the way the close sits in relation to those two data points works very well with these volume indicators. And this is the volume indicator you see beneath it is intraday intensity, was created by David Bastian, and we're solid green here. So there's no divergence. You keep on asking about what it would take to change my mind and stuff like that. We get to the upper here, and this is negative. This is in red territory. That would be a huge alert.
Okay.
But as long as we're running along here in green territory, there's just not that much to worry about. Let's skip that one. Here's a chart of rates. We got the 3-month through the 30-year and the 2s versus 10s. So, we're finally back to positive relationship in the 2s versus 10s. And as this is going to assume its normal shape over the next few months as the Fed relaxes short-term interest rates and such like that. I don't think that there's a lot of information here for investors to be concerned with. And then, these are some world markets. I like to see what's going on in the rest of the world. There's that giant spike in China. They said, we're going to, get behind the market. We're going to get behind the economy. We're going to do what it takes. And so, we had a few days of upside, but they had a big 1-week market holiday. It's their most important holiday of the year. And they came back and they had one more day to the upside now. Now they're unwinding all that.
Yep.
They're unwinding a good bit of it. But you can see that other than China, the rest of the world markets are pretty much in gear. My one worry here is the UK. The FTSE 100, which is what that index is, has proven in the past to be a pretty good leading indicator, and I would really like to see it rallying to confirm the strength in the U.S. market, but it's not. So this is a clear cautionary note for me.
Got it. Okay, interesting.
So let's see. I can stop sharing my screen here.
Go ahead.
No, got questions?
Yeah, I'm curious, you spoke about, or it seemed like a main focus for you is that market participants are not quite all on board with this bull market. Markets are rising and there's still, it feels like there's a bit of concern. There's people on the sidelines. Are there any other periods in history? You've been at this game for a long time. Are there any other periods in history where coming into an election, markets were behaving in a similar way?
Hmm. That's a hard one to answer without actually doing a specific study, which I didn't do before this. But in a general way, we say that bull markets climb a wall of worry. Um, and that's exactly what we're seeing here. We're seeing that wall of worry. We're seeing uncertainty about the economy. We're seeing uncertainty about the path of rates. We're seeing uncertainty about the election, and we're seeing huge uncertainty about the global situation. I mean, I just mentioned the Middle East and Ukraine and this new axis of power that's building up with Putin and Xi and North Korea and possibly some other leaders joining. So I just I think that there's a tremendous amount of uncertainty out there, and I think there's a lot of money on the sidelines, and yeah, and I think that's all probably pretty bullish until it isn't. But we talked a lot about those divergences and stuff like that, and that's how you tell the until it isn't part.
Yeah.
Right now we're pretty well confirmed. We've flipped through those charts really quickly and skipped a few, but even if you take some time to do it, which I do over the weekends, um, there's just not a lot to worry about in those charts. There are a few exceptions, but there are always a few exceptions.
Of course.
So, but if people want information on the market, I would really tell them to focus on these election markets that are driven by betting. The Iowa markets in the past were the classic ones that the academics studied. But this year, Interactive Brokers is hosting very, very active betting on. They have two series that are super active. One Harris takes it, one Trump take it, and they're slightly at odds, which is really, really interesting. Right? It's got to be one or the other. Yet, so, and I think that's further sort of indication of the uncertainty. Plus, those markets right now are quite new. So I don't know quite how much we can trust them, but I do like real money being spent on outcomes. I think it gathers information.
Yeah. They've definitely proliferated here in the near term recently.
Oh yeah. There's a ton of activity out there, and there are sites out there that aggregate it all, and so if you want to dive in, the water's plenty deep.
Yeah, I have to ask: do you have any sense on who you think is going to be the victor here?
No, I thought after the Harris announcement, the Biden Harris announcement, the change in candidate, such like that. She had initial very strong momentum, and that looked like it might carry through, but it hasn't really, at least not in the polls and not in the betting markets. So I have absolutely no idea.
All right. Last question then.
It's funny, I had a sense 2 elections ago. I had an odd sense that Trump was going to win. I thought it was just such an outlier sort of thing that it seemed plausible to me that it might happen. But I have absolutely no sense of this one.
What about particular names going into the election or maybe post-election? Is there anything aside from those key indexes that you kind of went over at the beginning? Are there any names that are sticking out to you as, just names that you're particularly interested in?
Well, we in a little pre-interview before we did this, we talked about NVIDIA, and everybody was betting that NVIDIA was done, but it doesn't quite look like it's done, right?
It sure doesn't.
I like the leadership here. I think you should stick with what's working, and I really mean that.
Yeah.
So when it's time for smaller stocks, I'm all over them. But I don't think you should be buying things that are just basing or that. I think in this type of market where uncertainty is as high as it is, you really need to own the leadership.
Got it. Okay. Right on. Well, John, thank you so much for your time today. It's been really fascinating going through all your charts and getting your perspective on things. We really appreciate you being here with us. It's been great.
Oh, my pleasure entirely. Thanks so much for having me on.
All right, John. Thanks. Have a good one.
Hi everyone, my name is Shay Boloor, but you might know me as Stock Savvy Shay on X. I'm here to talk about the 2024 election, and boy, is it going to be a very entertaining one. So, depending on what poll or betting market you see, it is going to be a coin flip. It's either going. I see Donald Trump's winning by 4 basis points, Kamala's winning by 3 basis points. Like nobody really knows. All I know is there's going to be volatility ahead of this major catalyst that's 3 weeks away. So how am I playing it? I think something as polarizing at this election where it's a coin flip, you kind of have to have a strategy for if Kamala's going to win and a strategy if Trump's going to win. So during this recording, I'm going to go over my 3 favorite names for each candidate. And before I show my technical case of like where I'm just saying it's going to pull back and where it's going to head if that candidate wins, I will be going over the fundamental basis because although I'm a long-term growth investor, I do wear a technical hat. So the way I frame it is fundamentals teach me what to buy, technicals teach me when to buy it. So that's kind of the order I'm going to go along with during this presentation, where I'm going to go over 3 names for Kamala, 3 names for Trump. I'm going to do the fundamental case first and then the technicals. So let's get started. The first candidate we're going to speak on is Kamala Harris. So what are the 3 names I'm bullish on if we are in a Kamala Harris-led presidency? The first one that pops up is First Solar. So what is First Solar? They're essentially the largest U.S. solar manufacturing company, valued at $20.4 billion. They're trading at 4.5 times EV to sales, 14 times 2024 free cash flow, while growing top line 35%. So on the far right, you can see specifically on what the competitive advantage is for First Solar. The reason I like them the most, I believe they're the highest quality among the group. Right now, you can see the solar energy comps right in front of you where there's 10 names. First Solar is right here. I'm also including Tesla just because the energy side of their business is firing all cylinders. But right now, we're going to talk First Solar because I do think they are the most heavily exposed if Kamala wins, mainly because the IRA is and the Section 45 tax credit will be a direct beneficiary on First Solar, where if Kamala wins and the IRA is still intact, their gross margins go from 20 to 22% without the IRA to 44 to 46% if they have the IRA. So that's nearly double the gross margins if the IRA is intact. So essentially double the profits for First Solar if Kamala wins versus Trump. So clearly they're going to be a direct beneficiary on Kamala Harris-led presidency. And if you see among the group, it has been a tough 2024 where nearly half of the names are showing negative growth, while you're seeing minimal profitability as well among the solar energy names, where even like Array Technology is one name that's profitable, Fluence is profitable, Tesla's profitable, but First Solar is among the cheapest among the names while also growing nearly the most among their peers. So they have a great combination of bottom line profitability and top line growth. And I just explained that if these credits are still in place, their gross margins theoretically should be doubling. So I think there's a lot of room for this name to run in a Kamala Harris-led presidency. So what does the chart say on when to buy? Pulling this up right here, I'm seeing, so clearly, if you look at this week, there's been some selling pressure. I'm anticipating this week there's been a lot of polling that Trump is gaining momentum on winning the election, and that's clearly impacting First Solar. Although they're up 3% today, you can see how red this candle has been this week. And I drew the flooring right here where ever since the gap up they experienced in May 20th and 2024, it has kind of continued to fill that gap. It hasn't really been able to break out. So even after this gap is retested once in August, retested it again in September, and right now it's at that same level. So I think if it kind of ranges over here for the next couple of weeks, I think that this creates a really interesting spot, mainly because there is a massive volume also basing over here at the 210 level, which is exactly where they're at. So it bounced at the floor from the prior test. There's a volume profile at around 210, 211. And I think if you zoom out, if Kamala does win, I could see just a retest right here of highs, and that's a 50% move nearly. So I think on a high quality name like First Solar, which is in the industry, solar industry is going to be heavily impacted on Kamala presidency. This is one of my favorite high quality names to capitalize on that. And there is a 50% move to be made, especially if it holds this level, which is it's shown it has. So where's the 21 EMA right now? That's one of my favorite metrics to use. 21 EMA is at 223. So I could see it retesting towards this level as we get closer to election, hopefully holding this base. But one of my favorite, besides the 21 EMA on the weekly chart, my next favorite metric is the anchored average VWAP. So that indicates the average volume and price that an investor trades this name in a specific time window. Every stock on their chart has a specific characteristic. You can't just use, I like to use 21 EMA on every name. Every name has its own characteristic. This anchored average VWAP kind of is able to be a good benchmark for that. So right now, if you want to, I like to use a volume profile to indicate, all right, so where did new investors come into this name? And it generally behaves along with the stock price then. So right now, I like to say, wow, if you look at this candle, it is just a ton of buying that happened at this moment in July 2022. And that is one of my favorite looking candles. So I'm going to track that right here. If you see that level, if we do break 200, if Trump does gain some momentum in the coming weeks, where is the near-term bottom? I see 178 right now around this anchored VWAP as a near-term bottom. And that makes more sense because look at this average gap, this gap we have over here where it is thin air. There's no volume profile. So I do think 178, probably closer to 180 actually will be a near-term bottom for the stock if it does break. So that's my first name for a Kamala Harris-led presidency. The next one I want to talk about is Alibaba. So I think the solar is going to do well for Kamala Harris-led presidency. The next industry is going to be China. Trump has been very aggressive on his policy towards China in his prior presidency. I think that's going to happen again his next term if he is elected. So if Kamala does win, I think the China tariff or China trade wars narrative will be removed. And that corresponds with a time when the Chinese government is really infusing a ton of cash to stimulate the China economy. And you're seeing a lot of the names across the board catch bids the past couple of weeks. I think that continues if Kamala does win. So why is Alibaba my favorite name among the group? Well, I view Alibaba as, again, I hate to use this term, but they are the Amazon of China, not just because of their e-commerce presence, it's because of their cloud presence as well. And now there is an AI tailwind kind of associated with that name going forward, where on their last earnings, they showed triple-digit growth in AI-related products. They showed double-digit revenue growth in their cloud products, and their e-commerce is picking back up now. And if the Chinese economy is picking back up steam due to all the stimulus that the government is providing, like e-commerce business should be flying off the radars as well. So that's my thesis on why I think Alibaba is a really interesting name that's going to probably catch a major bid if Comma does win. Mainly reduction in tariffs that are going to lower operational barriers and costs associated with being an e-commerce giant. And that's why I want to buy them fundamentally. And let's see where the technicals are taking us. So technicals over here, let me add them here. So the technicals are getting really interesting. So as you can see, it's been basing quite some time over here. So it's been basing for how long? Nearly 2 years. And it finally looks like it's curving up this 21 EMA. You can see the volume profile right here. It's just been a ton of volume accumulation happening in 75 range, finally breaking out. However, there's clear rejection at the 200 SMA on the weekly charts. This is a level that it hasn't really quite broken through. Might be a near-term resistance until we get through the election noise, because if Trump's gaining momentum, that is a no good situation for Chinese names. And I think that might be preventing the breakout. It looks like at this 118 level, that was a previous high as well in January 2023, previous high in July 2022. So like this is a heavy resistance for this name. And now that the 200 SMA is also aligning with that, I think 120 is a massive level. So if I want to see like if we do break 120, Comma's momentum continues, where is it going to go, the stock? So where's the volume profile showing? I have to go very far back to see where I can see some volume pickup. I think right here, there's a great candle right here. I don't know what happened right here in August 2016, but ton of accumulation. And it looked like this is what caused them to break out of this multi-year base as well. So this volume profile is telling me, wow, if it breaks 120, there is then volume over here. So now that's above this key indicator, I can see it like the first mini volume shuffle retesting is at the 150 level. But really, I think we slice through there, and the massive resistance is actually at 175. So my thesis, if this China theme continues and we're actually breaking out this multi-year base, I think 175 is a great spot for a price target in the next 12 months, because there's just so many tailwinds for Alibaba, stimulus for a Chinese government stimulus in the economy, Comma-led presidency will remove any kind of trade war fears. They're breaking out of a multi-year base over the 200-day SMA. Like there's a ton of different tailwinds aligning on Alibaba that 175 feels realistic. And if you look at the fundamentals, they're trading at 10 times free cash flow, less than 8 times EBITDA, 10 times earnings. Like if it went from 110 to 175, like it's still undervalued in my opinion. So like I really do think that is doable. And that right there would be a 40%, 40 to 45% move, even after being up 41% for this year. So first theme was solar, Kamala's presidency. Second is China name. What's the third theme? Housing. So Kamala Harris has been very ambitious on what her housing initiatives will be if she becomes president, where she's throwing out offers like $25,000 down payment assistance for first-time home buyers to boost the demand. She's also saying that she's going to allocate $100 million in HUD Pro housing grants to remove any barriers such as outdated zoning laws, local permitting issues, to help increase the supply and improve affordability. So housing is a major component of what she's running on. And there's really only 3 comps that I like to use for real estate stocks. It's Zillow, Redfin, and Opendoor. So Open Door is fundamentally going through a messy balance sheets. And I immediately like showing negative revenue growth while negative operating metrics being down 60% in the year. That's a no-go for me. But deciding between Zillow and Redfin, how did I decide which one to really target? It's because of their chart. Redfin's chart looks very interesting right now to me. So it has been basing for, again, since 2022. It's been going through a 2-year base right now. So because it's been going through a 2-year base and it looks like it's finally breaking out with the rate cut cycle beginning, as well as housing is a very hot topic in this upcoming election. And Kamala Harris is the most bullish among the housing stocks, but like it's still a topic of discussion that needs to be fixed for both candidates. So that is on the radar for a lot of investors. So it's been catching a bid in the past couple of months, mainly because the rate cut cycle began and also a hot topic among the election. But right now, like it went from $5 all the way to $14 in a matter of 6 months. So it nearly tripled in a matter of 6 months. It's pulling back a bit right now, but if you look at this trend since it broke out from this trend breaking bottom, it has really held its own right here. So I think if it holds right at this level, I using the 200 day SMA right here, I think it is really interesting on like if it holds this level, like it wouldn't be I feel like this level right here would be the magnet for this name. And guess what? That's 119% bounce off that trend level right here if it holds. So that's really interesting where like, oof, if Kamala does win, like that is that $22, $23 level is where I can see it. But let's see where the volume profile would be on this name. I like to use initially right here, I'm noticing a massive spike at this level. Look at that candle. Look at that volume accumulation. So if I want to use using that anchor VWAP from that massive volume accumulation, like if it does break here, where would it bounce? I'm looking at the $8 range. But again, like the volume is thin air above $10. So like if it does bounce here, I really do think it just runs up into that $22, $23 range. But that is the next bottom layer I'm seeing is at $8 range. So I do think that Redfin's an interesting play versus Zillow because it just tripled in a matter of 6 months. It's holding this range right here to a T, and the volume profile is just very thin air after $10 after a multi-year base. So I think this is a prime name to really catch a bid if we are involved in a Kamala-led presidency. So now that we go over 3 names for a Kamala-led presidency, it is going to be First Solar, Alibaba, and Redfin. Solar, China, housing. Those are the 3 sectors I think are going to catch major bids if Kamala wins the presidency. Now let's transfer over to Donald Trump. What happens if Donald Trump wins the presidency? The first name I want to bring up is the new AI darling, Palantir. So as you can see over here, Palantir, this is the top 15 most expensive growth stocks in the market right now. And if you look at the EV to gross profit, it has nearly 40 to 50% higher EV to gross profit multiple than the next level, which is Samsara at 27.9. So it is very expensive among the group. However, it's justified because there has been a narrative in the software space where AI will be cannibalizing the whole industry, which I think is absolutely accurate. However, there's going to be a handful of names that are going to come out of this stronger, and they're going to be able to charge unprecedented power if they can solidify themselves in the enterprise AI tech stack. Palantir has proven in the last 2 earnings they belong in that tech stack, and because of that, the market's bidding them up. Hence the 153 year-to-date profit, 153 year-to-date performance in 2024. But under Trump, that's why they're like the clear AI play because there's a security component to them as well, where in the Trump administration, Palantir could utilize their AI first mover advantage in data integration and analytics to secure a lot more larger and more complex government contracts for national security, immigration control, defense. If they are known as like how NVIDIA is known as the AI hardware play, Palantir is being known as an AI software play. I think that Trump's going to want to protect USA as much as possible against any kind of foreign threat. He's going to allocate a lot of budget towards that. And I think Palantir will be a direct beneficiary off that because they have a large component of their revenue is from the government. I think that's going to pick up if Trump is the president. So let's see how their chart looks. Palantir's chart is breaking out. Is the previous high right here was back in 2021. They are breaking out over here after the last earnings report. It is just taking off every single day. It's an all-time high. So I think this continues to run with the large government contracts being factored into their next couple earnings or next couple years of earnings due to the government side, while also corresponding with the commercial success they're seeing in enterprise AI. That's two massive tailwinds for this name. So that's why it's my number one stock on the Trump-led presidency, because we're seeing the strength in the commercial enterprise AI space for Palantir. The government side is very unpredictable. You can't predict what the deals are going to come through. They're consistently renewing, but the timing of it's tricky. But if Trump's goal is for increased security, national security, he's going to use AI, and you can anticipate the deals are going to be a lot more constant, a lot higher. So if there's any kind of pullback ahead of the election, I do like the $36 level. The next level is around $33. But like this name, like ever since May 2023, this massive bottom candle, that's accumulation. A lot of new investors got into the stock then. Like it's shown consistent support along the way, testing it multiple times in summer of 2023, and then again in January 2024. I don't think we ever hit this level, but I do think that's something good to call out just in case. $22. But the next volume shelf is $25. I don't think we're going to get there. I really think there's just so many tailwinds for a name like Palantir that you're going to have to take the quicker wins, which is $36 and then $32. So that's my first name. It's national security, but within the AI thematic for a Trump-led presidency. The next one is going to be Coinbase. I think crypto is going to be absolutely bullish if Trump wins the election. And mainly because he's more lenient on regulation, and especially in early secular growth themes like crypto. And I think his pro-crypto regulatory environment that he had in the prior presidency, I think that's going to be maybe the tailwind needed or a catalyst needed to kind of push a lot of the cryptocurrency as a mainstream financial asset potentially in the future, next couple of years. And maybe help like with the SEC regulations and compliance standards. Either way, Coinbase is going to be one of the biggest beneficiaries off this, mainly because the reason I cite I use these three brokerages as my comps for what crypto move to do rather than like, I don't want to do the crypto mining companies. Like I want a brokerage that has crypto exposure. That's like my main play, even though I think Bitcoin's a great investment as well. Same with Ethereum, but like using US equities, I do think Coinbase is the best name among all three of these, because a good example is like Coinbase's volume is around $37 billion in like crypto volume, trading volume, nearly double what Robinhood's is. However, Robinhood makes only 81 million off of their crypto trading volume, while Coinbase makes nearly 8x that. So the good example is Coinbase makes 8 times more revenue than Robinhood on crypto trading volume. So clearly the juice is being made for Coinbase. And I think it's because of a lot of the institutional trades are happening on Coinbase versus Robinhood, which is very retail centric. So where do I buy? Now I know what to buy. When do I buy in Coinbase? So let's look at the chart over here. Coinbase is interesting because it isn't near at all-time highs, even though crypto is kind of picking back a bid this week. It's struggling to catch a bid. So the first metric I want to use is like, all right, anchored VWAP. Where is the new? There's been a lot of new investors in Coinbase after it bottomed in 2022 and it's been basing for the next couple of years. A lot of people, if you look at it here, got in July 2023 at this breakout. It's been basing for 2 years. Again, very similar characteristic of the other names I talked about. And it's been breaking out over here. And if you track this anchored average VWAP, it has shown to be a clear support level. It didn't break it in February 2024 when it pulled back. It pulled back slightly during the yen carry trade issue. Actually, not the yen. This is the yen carry trade issue. It held up. But during the September sell-off, it broke through but picked back up. And you see over here, it's consolidating. So there's clear support at Coinbase at this level. I do think that it's somewhat worrisome on the volume profile at this level, because if it does break, I think we are in some trouble, because if you look at all their indicators, the metrics, it is below all of them already. So it's a messy chart, but if it holds up the anchored VWAP, I do think it retests this previous high. And if it does, that's a 70% move. And if you guys don't know, I am anticipating a blow off top crypto Santa rally. Like, I think this is November, and December is being priced into a blow off top rally for a lot of crypto related assets, especially if Bitcoin can break through that 75,000 level, which it's shown as resistance. But if it does break through, I think it's going to be a blow off top type of move. So I do think Coinbase is one of the biggest beneficiaries off that, because like I said earlier, they make 8x the revenue than Robinhood does on their crypto trading. So that's a massive move. So like once crypto's raging again, I think a lot of volume will start going towards their brokerage. So I went over the first name for Trump-led presidency. It's national security and AI. Second one is crypto industry. What's the third industry that's going to catch a bid on a Trump-led presidency? It's not what you would think. I'm talking EV. A lot of people think that EV would catch a bid on a Kamala-led presidency, and that's absolutely true. There is nothing, you're not wrong in that at all. However, due to the massive advantage that Tesla has over their competitors on a profitability basis, I think if the IRA or the tax credits is removed from EV cars, no other competitor has the profitability margins that Tesla does. Tesla has a first mover, large market share that they can like have the pricing power needed to undercut their competitors, like we've seen in the past 2 years. Their competitors don't have that luxury. So if those tax credits are removed, I think that removes the crush that the Tesla's competitors have been living on for years. And that's just going to allow the best of breed, clear number one, just widen the delta between them and everyone else. So although it might hurt Tesla fundamentals, I think it's more of a pain for their competitors, where it's a lesser of two evils, and that's going to benefit their moat or the advantage. And I do think a Trump-led presidency, like the relation that Trump has with Elon, is hard to ignore. Like, they are friends and they're very public about it. I do think that it's going to help. Trump might help a lot with the regulatory approvals needed for robo-taxis or any kind of initiatives on Elon's vision on SpaceX, Starlink, Tesla. Like, regardless, like, I think it's more of a scratch your back, you scratch mine if you become president. And I think that's going to be a major benefit for a name like Tesla. So now you know what to buy. When do I buy it? If you look at the Tesla's chart right now, they just had their 10/10 robo-taxi event just yesterday. It was a big disappointment, as you can see with this massive weekly red candle. There was lack of clarity on exactly when the robo-taxi fleet are going to be released. They said the price point is pretty vague, under 30,000. There wasn't any kind of detail that the market wanted. It was very visionary rather than actual specifics on what to do going forward on the robo-taxi fleet. So Right now, the chart looks a little troublesome, where if you go in the past year, this 265 level has been a clear resistance. Like, it is struggled to break through it in October 2023. It struggled again in December 2023. It struggled again in summer of this year. And guess what? Same level, this most recent rally, ever since the 70% bump from August bottom, it's been in clear resistance then. So I do think that if we do break this 265 level, I think it's going to really break out, where if you, let's see, pull the, this is a great base right here. I think if it breaks the 265, you can see how thin the volume is above it. So like, who knows? Like, I can see us testing the prior highs in 2022 potentially if we finally break over this 265. Worst case scenario, like if it continues going lower, things do get a little worrisome if you can't hold up on this level at the 21 EMA at 219. You can see like it should be holding up there. It's been support prior. If it doesn't hold up there, I mean, maybe the 50 SMA on the weekly charts at 207. But worst case scenario, like this trend we've experienced since 2019. So if we don't break through that 265 level, I do think that a next resistance will be the 207 at the 50 SMA on the weekly charts. And maybe worst case scenario, like you see this bottom trend like ever since 2019, you can see that has been being held up. So like that's a long-term trend resistance. So I'm hoping that worst case scenario, I really don't think it breaks 150, but I just want to give a worst case scenario environment if we do pull back. But I really feels like this is a consolidation level, but if a Trump does win this election, like it will I do think that's going to be a tailwind needed for them to break through a 265 level. And that top is going to be, the prior high is in 400. So like there's a ton of room to run for this name if it breaks above 265, because especially the thin volume. So I've gone over on a Kamala Harris-led presidency, the three themes I think are going to be the hot pockets of. It's going to be solar, it's going to be China names, it's going to be housing. In a Trump-led presidency, it's going to be national security, and I think AI is going to be the main beneficiary of that, which is Palantir, the king of the AI applications. The second is going to be crypto because of the lack of regulations that he kind of has had in the previous presidency. I think that's going to continue. And the third one is going to be EV is going to struggle, but Tesla should benefit because they are the clear winners of this comp, and they're going to benefit from the destruction of their competitors, from that IRA tax being removed. Tesla should be able to catch a major bid from that. That's the 6 names I think that everyone needs to have on their radar to anticipate this 2024 election. I will say I am very surprised that the market really hasn't pulled back to retest those September lows when we are in a seasonality weakness period of September and October. The election is 3 weeks away, where it is very polarizing, where nobody knows who's going to win. It's a flip of a coin, essentially. But I did highlight the specific sectors for each candidate that I think will catch a bid. And I think the follow through on the election is going to be beneficial for those names as well. So I try to orchestrate a fundamental and technical basis for each name that I think will be the biggest winners for each of the presidential candidates. And we'll see where it goes. As of right now, I can't even tell you who's favored because it is just so 50-50. But all I can tell you is be prepared, have a plan, because things will be getting highly volatile in the next couple of weeks, where the market hates uncertainty. And you could see some profit taking occur because the market is up 25% year to date. And they want more clarity before getting through the end of year rally. Because right now we just hit all-time highs. And typically I don't get bearish when we hit a new all-time high, but due to the major catalyst for like the election, I could see some profit taking occurring, especially in the month of October, where things feel a little squeamish on holding names because there's a ton of seasonality weakness. So there you go. Hope you guys enjoy this. The top 6 stocks I'm recommending that I think will benefit the most from this upcoming election. Thank you.
Hello and welcome to this special TrendSpider Election 2024 stock market review. My name is Tyler Wood. I'm a CMT Twitter holder, and as always, I am joined by Alex Cole, the chief of charts here at GoNoGo. How you doing, my friend?
I'm doing very well. This is going to be a fun one.
It's going to be a great one. Nice to see you pre-market. We're recording this on October 9th. And to all of you who are watching, hopefully what you take away from this is perhaps a little perspective on how you can use technical analysis to keep your emotions or your biases in check. And listening to the market is one of the most powerful things that technical analysis provides us. Over the last several weeks, we have seen consistent news flow of very negative events. Our hearts and minds go out to all of those folks affected by multiple hurricanes. Category 5 Milton about to break ground on the coast of Florida, multiple wars raging around the world, and a lot of devastation and destruction. And with that as our backdrop, as investors, we could become exceedingly pessimistic on where the market may bring returns year end with that much negative news attention. So, Alex, why don't we bring up a chart of the S&P 500 and just take a look at what the market is actually doing in the face of all of this horrific news.
Yeah, absolutely. And this is the S&P on a daily basis at the moment. And we're looking at go bars. So all of this that's happening, we like to say, don't predict, just react responsibly. And we can see that in the last couple of months, we've re-entered a go trend. We're close to all-time highs, and we've got some strong blue bars at the end of the chart here, with the oscillator staying above the zero line. So we have to look at the charts and read them for what they're actually telling us. And at the moment, prices are in a go trend, and we're seeing signs of trend continuation.
Now, if you're new to GoNoGo Charts, the whole idea behind simplifying our data visualization without losing that important technical information is how we arrived at these charts. So everybody's developed an algorithmic way of looking at markets, combining multiple indicators. For our algo, instead of leaving it in the black box, we wanted to display those results in real time. So what you see on screen is a price panel that gives us an idea of the direction and strength of trend. So aqua and blue bars are in what we call go conditions. If you think about a NASA shuttle launch, you want to make sure that all the probabilities are on your side before you shoot billions of dollars of hardware into space. So that is a go condition when all of the indicators that are blended into these tools are in their positive and rising conditions. When you see purple or pink bars, you have strong or weak form, respectively, of a no-go trend, meaning that it is trending to the downside. And on occasion, at moments of transition, you'll see the market give us a signal that it's frankly undecided. There's a neutral reading across all of the indicators that are blended into this trend model. And as big fans of the life and work of Jesse Livermore, we refer to these as go fish bars, because in all markets, there's a time to go long, a time to go short, and a time to just go fishing. So there's a little background on that trend model. We're going to dig into that lower panel, the GoNoGo oscillator, which incorporates momentum, volume, and volatility here as we go through today's chart review. So S&P 500 on a daily basis in a go trend. But let's back this out to a weekly time frame, Alex, and get a little more context about where we have come from. Now, when we look at multiple time frames, obviously the volatility that we saw in early August, just a counter trend correction when you're looking at a weekly time frame. So the algo adjusts to the time that you are looking at, and those very significant moves on a daily or intraday chart don't even break the trend conditions. And one of the tenets of trend following is to simply stick with those securities that are working in your favor. And GoNoGo Charts helps you stay in trades throughout the period of the move by giving you those trend conditions and helping you understand that we haven't yet broken down below trend on this weekly time frame. Alex, why don't you talk a little bit about that lower panel, the GoNoGo oscillator?
Yeah, and just to highlight what you're talking about there, we are in a go trend, but we want to understand the strength of that go trend. And that's where a lot of people will then turn to momentum. Momentum tells us so much about what we're seeing in the price panel. And we want to know that the enthusiasm or the momentum of the market is on the side of the trend that we're looking at. So when we created the oscillator, in the same way that we created the trend indicator, we blended together several of the foundational concepts of momentum analysis into just one oscillator so that we wouldn't overwhelm our price panel. So we've got a lot of inputs to this oscillator, different sensitivities of different oscillators that are well used in our industry. And when we put them all together, we get one oscillator that's moving from -6 to +6. But the really powerful piece of this, Tyler, is that when a security is trending, we can use our oscillator for objective levels of support and resistance. And that's because when we created it, we did it in a way where when the inputs are in their respective neutral territory. So if you think of an RSI moving between 70 and 30, when it's in that neutral period, if all of our inputs to the oscillator are in those neutral areas, then our oscillator falls or rises to the zero line. So what you want to see during a strong trend is the oscillator providing support if it's a go trend, or resistance if it's a no-go trend. So when we look at this trend, it's been in place now for quite some time. We're looking at about a year and a half here. Primarily, the oscillator finds support at the zero line. Now, back towards the end of last year, we saw a much bigger area of concern where the oscillator did not find support at zero. It moved into negative territory, and we saw a much more drawn-out correction, even an amber bar on the weekly chart when that happened. But a return to the go trend, the oscillator back in positive territory. And then since then, you can see we've been finding support at that zero level. So very, very powerful piece of the tools. And what we're looking at now is a go trend at highs with the oscillator in positive territory, confirming that trend. Now, if anybody has done any kind of technical analysis work and you're looking at sort of size of candles, length of wicks and all the rest of it, you'll see that these candles are quite small. So there is some deliberation happening here. There is a narrowing of trading range, and we're seeing lower levels of momentum than we did on the previous highs. So taking that all into consideration, though, weight of the evidence still says we're in a go trend and momentum is positive on the weekly chart. And that allows us then to drop down in time frame and look for sensible areas to make decisions.
So, as an overall lesson to all users of technical analysis, what we're going through right now is a process of data collection first. So, before we make an investment decision, before we decide where to place our capital to work, we need to understand what the market is telling us. So, I know the topic for today's session is how would you position your portfolio if the Democratic candidate or the Republican candidate takes office here in the upcoming election on November 5th. What Alex and I would argue is that you should take a process to review the detailed information in front of you, because the market is a discounting mechanism. It means that all of the growth factors, the valuations, all of that fundamental information about the companies or the securities that we're investing in, as well as all of the macroeconomic data, as well as everything that we couldn't possibly know. What's happening inside the boardrooms at these companies? What new regulatory hurdles might several of these firms be facing? All of that is baked into price. And price is such an elegant and simplistic distillation of all of that information. We can use it to our advantage so that we don't anchor to one piece of data or one belief that we have about a certain company or a certain country or a certain outcome of the election. So hopefully this isn't too disappointing to the audience here, but regardless of what candidate you are voting for, the market could care less about your opinion. And you may be very despondent on November 6th that your candidate didn't win. That will not change what the market is presenting you. So all of the analysis around whether or not a Republican-led Oval Office or Democratic-led Oval Office has an impact on the market. What we're seeing right now is that despite all of that indecision about this upcoming election and the fact that it is a very important one for civic engagement, we encourage you all to get out there and vote early and vote often, but you don't necessarily see that showing up in any kind of meaningful way to disrupt the trend that is in place for the S&P 500. So Alex, let's continue on, because the analysis doesn't stop at the index level, nor do we even just take a look at the top line cap-weighted indices. Let's take a look at the S&P 500 on an equal-weighted basis. We can use the ticker symbol RSP. Now we're getting a sense of what breadth is doing, and you've heard a lot of analysts talking about the healthy rotation of this market. We've seen a lot of new leadership emerge, and frankly, in a very frenetic, very fast-paced rotation, seeing different sector groups, different styles leading throughout the year 2024. So on an equal weighted basis, Alex, here on this weekly chart, I'm seeing similar go trend conditions.
Yeah, and actually we're seeing, a sort of a more even progression through this trend with higher highs and higher lows. And you can see again the oscillator finding support at that zero level. At the moment, we've just come off a new higher high. Now, those red triangles, Taylor, those are our go counter trend correction icons. And that comes when our oscillator has gone overbought and then come back to neutral. So what that tells us is that in the short term, there may be some struggles for price to go higher, just like we saw here after this one. We saw a little bit of a fallback before the trend continued. So that tells us that momentum has been very high and has waned just a touch. So that tells us over the next couple of weeks, perhaps we'll see some consolidation against the trend. Perhaps not, right? We know that any kind of overbought condition sometimes means that we'll just blow through that warning. But there may be some struggle for price to go higher in the short term, but certainly doesn't mean the trend has ended. Trend is still painting those go bars, and momentum is positive on the weekly chart.
Now, earlier this year, coming into 2024, I've heard countless analysts criticizing the market's rally based on the narrowness of breadth. So they were talking about the Mag 7 being the only things holding up the index, and that the average stock in the index was not performing nearly as well. And so when I explain breadth to college students, and I do do a lot of lecturing about technical analysis, I let them know about my absolute all-time favorite team, the 1990s Chicago Bulls. And of course, everybody thinks about Michael Jordan, the greatest basketball player of all time. Sorry, Steph Curry fans. But it wasn't just Michael Jordan. That was an incredible team with a deep bench of incredible players. Scottie Pippen and Dennis Rodman, and every person on the team had a job to do, and they did it exceptionally well. So while Michael Jordan was quite the star, the way you win 6 back-to-back NBA championships is by having a complete team that can support that kind of championship play. So this rotation, what we're seeing on an equal weighted basis, is the average stock in the index is also participating to the upside in strong go trends. And that is a really powerful indication of a bull market that is healthy, alive, and set to continue. Now, Alex, let's talk about the orange grid in the bottom of the GoNoGo oscillator panel.
Yep.
So tell us a little bit about volatility compression.
Yeah, I mean, we talked just a little bit about how important that zero level is for our oscillator. So remember, that means that all of the conditions, all of the inputs to our momentum analysis are in their neutral territory. So that means there's very little directional movement when the oscillator hits zero. We've got no overbuying, we've got no overselling. The inputs are in their neutral territory. So if you expand on that, think about what that means when the oscillator gets stuck at the zero line. That tells us that there's very little winning being done by either the bulls or the bears, right? You're in this virtual tug of war between buyers and sellers. So for every bar that the oscillator stays at zero with no overbuying conditions, no overselling conditions, no directional momentum in either way, we allow the GoNoGo squeeze grid to climb for every bar that the oscillator is stuck at zero. So as that grid climbs, it tells us that we've been in an extended period of that neutral momentum where we aren't seeing any enthusiasm or any winning from one side or the other. Because, of course, this could be a lot of trading activity, but the oscillator being unable to get away from the zero line tells us that we are not seeing much movement in one direction or the other. And you can see that in price. As the grid builds, you can see that the range of trading sort of narrows here. We're seeing that consolidation as nobody's really winning. We're not pushing prices higher or lower. So as that price movement moves sideways and volatility compresses, we see the climbing grid of the go-no-go squeeze. And then, of course, it becomes important to watch for the break of that squeeze. So if you're familiar with Bollinger Bands or Keltner Band squeezes, that's what we're really looking for. We're looking at these periods of reduced volatility, and we're highlighting them on our oscillator panel with the go-no-go squeeze grid based on how important we know the oscillator being at zero really is when in trend. So then we look to see the breakout. And if all else being equal, if you're in a go trend, you see a buildup of a max go-no-go squeeze, you see the breakout then in the positive direction. That's a signal or a sign that the trend is likely to continue because, of course, we're seeing resurgent momentum in the direction of the trend. So those periods of volatility, people sort of shy away from volatility, but finding those periods of reduced volatility that can lead to periods of increased volatility, those are powerful moments. And I always used to be told that it's like squeezing a tube of toothpaste until eventually the top pops off. And that's what you're getting here with that release of volatility as price action starts to move more aggressively. And then we've moved, of course, to new highs since then.
And of course, those critics of breadth really reached a fever pitch in May and June as this equal weighted S&P chart is telling us. There was real stagnation, and I'll admit I myself wasn't really sure what direction this was going to break, which is why we use the evidence in front of us to make sound, objective decisions rather than fall victim to our fear or greed. So when we see the break of the go-no-go squeeze, momentum takes off in the direction of the underlying trend. And that's where we see breadth expanding, the average stock in the S&P 500 also climbing to new highs. Okay, so now we're just talking about the U.S. equity market. We're in a bull market. It's in strong go conditions on both a cap-weighted and an equal-weighted basis. For all of you who respect John Murphy and the power of intermarket analysis, we can do some top-down views. Doesn't mean you have to trade bonds or currencies or commodities. But from all of those markets, there's a ton of information that will tell us about headwinds and tailwinds to the rest of the marketplace. So, Alex, let's take a little top-level view of what's happening across the asset classes. Let's just pull up TLT, long-term bond ETF, and of course, everyone's eyes are on Jerome Powell. I would argue he has much more impact on the marketplace than any presidential candidate ever has. And I'm sure our good friend Ryan Detrick, fellow CMT charter holder, is going to show us a lot of the historical data about what has happened to markets in election years when you have an incumbent candidate and what happens to markets. But if we're just looking at the bond market and knowing that bond prices are going to move inversely to U.S. interest rates, rising bonds, falling rates, and we know that a liquidity environment where the Fed is cutting. Yes, the first cut was 50 basis points, and I know there's infinite speculation about each and every Fed move. Instead of worrying so much about parsing the language and going through the FOMC meeting minutes, we can look at what the market digests out of those moves by simply looking at price action.
Yeah.
So, Alex, talk to us about what's been happening here in bond prices of late.
Yeah, and so this is a weekly chart. So remember, if we drop this down to a daily, we'd see the movements sort of in more detail. But you can see that over the past period of time here, we've set higher lows and we've moved into a go trend on the weekly basis. So that means bond prices in a go trend. And so, of course, rates have been falling over this longer period time frame. Now, if you look to the very last few weeks, you can see that we have fallen away. Prices fallen lower for Treasury bond prices, but we are in a go trend. The weighted lead evidence says that we are still in a go trend on a weekly chart, and we are looking at the zero line on the oscillator because it's being tested right now. So we've seen this sort of reaction against this new go trend over the past couple of weeks. This is going to be a very important moment, Tyler, because we're going to watch to see if the oscillator finds support here and bounces back into positive territory. And if it does, then we may see this as a new higher low as bond prices move perhaps higher to challenge for new highs. Of course, if the oscillator breaks the zero line into negative territory, that would be more of a concern. And you're seeing that movement on the daily chart moving lower in more detail.
Absolutely. Let's turn our eye to the U.S. dollar. Dollar strength, dollar weakness, having a big impact on the globalized corporations that we work in these days. So we like to use ETF proxies. So for the dollar index, the ticker is UUP, and we have seen over this weekly time frame quite a bit of chop.
Yep.
And actually, Alex, I like the longer term view, because we've been drifting lower now for quite some time. Since January 2023, we've stabilized in this range, if not drifted lower overall in the dollar index. And that is an inherent tailwind for risk assets and for U.S. equities. And if you zoom back into kind of that right side of the chart, we can see that the GoNoGo oscillator retesting the zero line from below. We're back at neutral, but still very much in that range. We're not seeing dollar strength taking off to the upside, nor are we seeing it collapsing under the weight of rate cuts. That to me signals to all investors, right? Stable US dollar is incredibly helpful. I think what investors really get spooked by are rapid moves in interest rate hikes or falling, or rapid moves in dollar strength. And we're just not seeing any of that, but much more range bound activity and stable over the past several years. So Alex, let's move on from the US dollar. Let's take a look at IAU, a proxy for gold. Now, all through the pandemic, going back 4 years, there were a lot of investors talking about, gold is the flight to safety. Throughout a rising rate environment, you're going to see gold spiking to highs. We didn't see that materialize. And the textbooks would tell us that we wouldn't see a risk asset or equities rally at the same time that you would see a gold rally. But that is what is happening. The markets are there to fool as many people as possible at any given time. And we are seeing gold above that major $2,000 an ounce level that has been resistance for almost 15 years. Breaking out above 2,000 an ounce gave room for that trend to really move to the upside. So, Alex, talk us through what we're seeing here for gold.
Yeah, it was really an amazing thing to watch. So many of us were looking at that sort of 13, 14-year pattern on the really long-term charts, looking for that breakout above the resistance for what a lot of people were seeing as a cup and handle. And it just kept trying, didn't it, all the way through those few years and not doing it. And then, of course, now it's really broken above those levels. And we're quite far away from that now, and there's really nothing above it. So we've got a lot of analysts really bullish on gold. And you can see that this year, we just have seen so much of that movement that people were waiting for so long. And if you look at it just from purely a go-no-go perspective, we're in strong blue go bars on this weekly chart at new highs. Oscillator's been finding support at zero. And now you can see that we are actually still, we're remaining elevated on the momentum oscillator, and we're at a value of 5. So at the moment, we're still in overbought territory. We'll watch to see if it does cool off, and perhaps we'll see a counter trend correction icon and maybe a few weeks of pause, but certainly looking very, very strong on the weekly chart.
And so in terms of asset allocation within your portfolios, the fact that precious metals are moving in this way and they are a non-correlated return stream, it might make sense for folks to think about diversification and capturing trends no matter where they are across the asset mix. Gold has certainly been a strong performer here in 2024 and is not showing signs of giving up that trend anytime soon.
Yeah.
Let's take a look at another couple commodities. Let's take a look at USO and get a sense of what's been happening in the oil markets. Now, if you're a fan of Martin Pring and you've been reading about the business cycle and the liquidity cycle, you're going to understand that commodities tend to trend in late stage environments. And so when we're seeing rapid increases in the cost of energy and fossil fuels, that can be a real headwind to business operations. Since the middle of 2022, we have seen this same range-bound stability in oil prices, and seeing it on this chart, right? We spiked back to the average after the COVID collapse, but we're not seeing runaway prices in oil, and that to me is a very stabilizing factor for a lot of businesses and for investors at large. So Alex, if we drop into just the daily basis, right, for those oil traders out there, get a sense of kind of this chop and this mean reverting work that's been happening in the range, you can still use GoNoGo charts on shorter time frames to capture those moves and use the GoNoGo oscillator to your advantage. So when we talked about breaking the zero line or finding resistance at the zero line, do you want to talk to us a little bit about the icons that show up on the chart to show us some trend continuation?
Yeah, absolutely. And so what we like to do is bring the visualization or bring the data, the understanding of the data back into the chart through data visualization. And we're both big sort of fans of data visualization and done a lot of work and research in that area. And I think what we tend to do sometimes is cloud our judgment through having so much information, but not an easy way to sort of understand it. And for me, understanding it is often by visualizing it. And so with the icons that you see on the chart, these triangles and these circles, what we've done is we've tried to highlight the important interactions between the momentum panel and the price panel. So let me give you an example here. In this period of a no-go move, when the trend is in place, we turn our eye to the oscillator panel to understand whether or not momentum is finding support or resistance, as we mentioned earlier, at this objective zero level, because we know that if we're in a no-go trend, momentum should stay at or below zero. We should have periods of selling, maybe then some neutral momentum readings, and then more selling again. So whenever we are in a no-go trend and the oscillator turns back into negative territory, we're going to give these no-go trend continuation icons on the chart, which tell us that now we're seeing momentum again aligned with the trend. So you see here as well, we had this sort of relief rally, we had the pink no-go bars, but as soon then as the oscillator turns back into negative territory, we know that momentum is resurgent in the direction of the trend that's in place. And of course, in this case, no-go trend in place. So this is a no-go trend continuation icon, which tells us that in all likelihood, price is likely to continue in that direction. Of course, then when we come back up here, later in the chart, we see a strong relief rally, lots of pink bars, an attempt to roll over as it hits resistance from these prior lows. But the oscillator does not get back below zero this time and instead finds support at zero. So we don't see trend continuation. What we see is more uncertainty. We see some amber bars, some go fish bars, and then, of course, now a first go color, the aqua color for the first bar here in a go trend with momentum now in positive territory. Now, the other last thing that we haven't talked about on the oscillator here, Tyler, is the changing color from the lighter aqua to the darker blue. And what we've done here is by putting an emphasis on volume when that line changes color, it can give us that volume analysis, that confirmatory indication of what's happening with the trend. So when you see the darker blue, that tells us it's heavier than normal volume. So in this period of a no-go trend with prices moving lower, we saw pretty heavy volume. So that's the market participating in that trend. That sort of represents market enthusiasm for us. Interestingly then, price moving higher on this relief rally, volume weakening. So there's that uncertainty here. But as price has really kicked on and moved higher, the volume has come back. So that volume here on these last 3 or 4 weeks tells us that the market is enthusiastic or participating in this move higher. Now, I know that was a lot. Last thing I just want to mention here is because we only have the one panel which is large for price, because we put all of our price tools into the colors and we just have the one panel on the bottom for everything else, you can still quite easily see important levels on the chart. And you can see how firmly price was rejected at these horizontal levels that were resistance before. So this is going to be a crucial area for price to get through. But at the moment, new go trend. excuse me. New go trend and positive momentum on heavy volume.
So a dear friend of mine, Buff Dormer, who is probably the world's foremost expert on volume studies, said that price is the testimony of the market and volume is its polygraph test. So the price action is going to tell you what the market believes is happening, and then you're going to find out if it's lying to you by checking with volume, which I thought was such a powerful analogy for using that confirmatory indicator to your advantage. All right, Alex. So new candidates, a lot of discussion in all of the debates about energy policy, about pipelines, about the geopolitical tensions that we are facing. Do they have an outcome, an impact on price action for energy prices? Of course they do. Would I be able to tell you, even if I knew right now, crystal ball, who's going to win and exactly what policy measures they're going to put into place? I couldn't tell you when those would take shape in price action, how the energy industry is going to digest that, and what other forces might be impacting. So having a crystal ball about a presidential election is not going to give you the information to be a profitable trader or investor. But on that thread of geopolitics and thinking about a large global marketplace of securities that we could invest in, I think it's helpful to talk to every investor about diversification around the globe. So let's take a look at a couple of other country level equity indices and just see how they're doing. Let's check in on my friends in India. INDA is a ETF that captures the Indian equity markets, which have been dynamic and growing, very strong economy and incredible participation in their markets. So going back to the summer of 2023, right, over a year and a half, we have seen this go trend continue with no break in momentum below the zero line. We're seeing positive momentum on the heels of this rip roaring go trend. These last couple of weeks, a lot of the headlines in India and a lot of the folks that I work with over there are talking about, major meltdowns. People are freaked out about the volatility that they have seen in the last couple of weeks. But when you zoom out to a longer term chart, it's a very healthy counter trend correction. We're not even testing the zero line yet. And that helps illustrate this power of the emotions and the bias that we bring to our analysis. When in doubt, zoom out, and a healthy correction on a weekly chart may be very destructive for intraday traders, and your risk levels would have been stopped out far before this. But for longer term investors, contraction within an uptrend, right? We know it doesn't move in a perfectly straight line, but climbs higher and backfills throughout the trend. That is healthy. And in the raging bull market of 2021, I saw countless experts on social media talking about just buy the dip, every time it corrects. It's just another buying opportunity. And so what Alex was talking about with that retest of the zero line, finding a quantifiable way to tell us when a correction is a healthy correction and an opportunity to add to your position size or to enter a trend that you weren't participating in yet. That's the power of GoNoGo Charts, is that we want to take our bias and emotion out of this, but we still want to be responsible. We don't want to just BTFD all along the way. We want to make sure that momentum is triggering to the upside, confirming the underlying trend. Alex, let's take a look at another one that's been all across the headlines and I'm sure shown up on everybody's scans and alerts. MCHI. China has been ripping to the upside most recently, but after a very long-term downtrend. So we've seen years of a lot of destruction of the equity markets in China. Xi Jinping doing a whole lot in terms of rate cuts and a lot of conversation about a new fiscal policy. Looks like investors are digesting that news in a positive way. But what we're going to use is not Xi Jinping's commentary. we're going to look at how the market reacts. And Alex, why don't we drop this into a daily or even intraday look for those shorter term traders. So here's our daily. And if we simply enter the go trend when it is signaled, you're capturing all of that upside move, right? Now, none of us can tell you what happens on the right side of a chart. We don't have the ability to predict the future. Sorry to break it to you. But by simply following our rules and participating in go trends, getting out of no-go trends, if you're a long-only investor, that can be really powerful in terms of capturing reward and return. So let's move on again, Alex. We had a incredible VIX spike, and I know in the interest of time, we're gonna move quickly through these last few charts. But let's pull up the VIX. Early August, we saw a spike to around 60. That was a painful Sunday night going into Monday morning. We saw a lot of volatility, and yeah, we can jump that out to the weekly. From the start of this bull market, we have seen waning and calm instruction from the VIX, and that spike that we got in August certainly changes the trend, but we have not seen that break to new highs, right?
Yeah.
We are still stuck below resistance, save for that one Monday in early August. But talk to us a little bit about what we're seeing in terms of longer term trend on the VIX indicator.
Yeah, I mean, I think just generally we are at low levels for the VIX. I mean, people talk about having certain levels that they're happy with, below 30, below 25, whatever that might be. These are not high levels for the VIX. Of course, this one period here in August was quite a spike, but that quickly came back off. And as you said, now we're below these levels that were resistance before. So generally speaking, volatility is still low. Now, having said that, we have seen a change and we are in go colors. So we're definitely above the lows. And so we want to just keep an eye on this as it moves forward, but definitely still not high levels of volatility.
And when the Bank of Japan gave us a surprise interest rate policy decision, and we saw a massive unwind of those carry trades, it's all widely understood after the fact. And in the moment, it's very difficult to pinpoint what is causing market moves. And I would encourage all of us to not consider ourselves such an expert that we could explain in real time exactly what is driving markets. That's usually a story that comes out weeks later in the news. But what we can do is react responsibly given what the market is telling us. All right, Alex, back to the S&P 500, back to our equity investment strategy and thinking about this election. What I would encourage everybody to do is from this top level perspective, right? We've seen the volatility is pretty supportive. We've seen that oil markets are very stable, that interest rates are now even moving in the favor of a tailwind. And we have seen bond prices begin to rally as rates are falling. If we dive under the hood of an index, we can take a look at sectors, we can take a look at industry groups. And so for the S&P 500, let's run through the sector ETFs real quick and just get a sense of the overall trend of what's happening. And then we'll look at a couple of ratio charts as well. So let's start from the top. XLK is the information technology sector. I'm seeing go trends, Alex. Talk to me.
Yeah, absolutely. I mean, that's a pretty nice one. Of course, there was a pretty big fallback here from the go trend counter trend correction icon, but stayed in go bars. We can see that the oscillator right now is testing the zero line. We're in a go-no-go squeeze, so we're going to watch to see in which direction that resolves. But yep, a go trend for the XLK.
How about XLY, consumer discretionary?
Yeah, very similar story. We did see some amber bars creep in at these periods where prices fell back, but no goes. And now we're in go colors with the oscillator in positive territory as well.
Fantastic. How about the communications sector, XLC?
Even better. The sort of pullbacks even less pronounced for the communications sector. And we can see that the oscillator's been finding support at zero over the last several months. So new highs, positive momentum, go trend for all of these growth sectors on a weekly basis.
Now, I know I'm cheating because I've already looked at the industry groups that make up the communications sector. Those that are pulling this higher include media companies and advertising. And who would have thought that in a highly contested, very dramatic national election for the presidency of the United States of America that there might be more ad spending, more advertising. Yeah. So if there's one takeaway for elections, it doesn't matter which candidate you are rooting for, you can participate in communications trends as all of that ad spending ramps up. All right, let's move along and take a look at the XLE, the energy sector.
Yeah, so as we saw with the oil charts, the energy sector has been super choppy, especially on this weekly basis. So not really telling us much here other than market is unsure. We're seeing these amber go fish bars, oscillators struggling to get away from the zero level. So a very choppy chart for XLE.
Absolutely. And let's move on. How about industrials? XLI.
Yeah, so the industrials has been in a solid trend. We did see that period here where we dropped below the zero line and then a no-go for a few weeks or a month. But then for the last sort of almost a year now, or just about a year, we're seeing that trend take place. Go colors, oscillator in positive territory. So looking pretty good for industrials as well.
Absolutely. How about materials? XLB.
Yeah, similar story, a little bit more movement, but yeah, we're in a go trend, strong blue bars, oscillator positive territory. And we're seeing all of these continuation icons as price moves sideways. You can see how many times the oscillator went back into positive territory. So that was a good sign. And then, of course, now we've made new highs.
And I love that there isn't a clutter of indicators on that price panel, because we were in a range bound area and broke to the upside. And now that trend is moving higher. Being able to identify Darvis boxes or flags or pennants, whatever pattern recognition you may have read about in your studies, being able to see a clear price panel is powerful to see those clear levels of breakout. Moving on, let's take a look at the financials sector, XLF.
Yeah, again, on a weekly chart, what a nice move. Very sort of smooth and consistent, not a lot of pullbacks. And you can see again how important that zero line is when we're in a strong trend. You see that period of sideways movement and then the breakout higher as the oscillator breaks out of a max go-no-go squeeze here. It's already found support again, and now we're at higher prices. So you can see very consistent momentum here, staying at a value of 3. So we're watching that now, but definitely momentum on the side of the go trend.
And how about healthcare, XLV?
Almost almost the same, right? Like strong trend, oscillator finding support. Now instead of being in positive territory, we're seeing the oscillator back at 0. So we're watching that test of the zero line. If it finds support here, we'll look at likely trend continuation on the price panel.
Absolutely. And let's take a look at consumer staples, XLP.
Another one. I mean, this is the beauty of pulling things back, right? And like making sure you're looking at the larger context, because we are seeing strong moves across these sectors for participation in the larger trend of the S&P.
Mm-hmm. And utilities, which had been rip-roaring this year as electricity prices continuing to climb. Yeah. Another bull market chart there, Alex.
Yeah, and this is just real quick to highlight the length of this no-go move and then how important the breakout of these squeezes was here. Like a long, drawn-out max go-no-go squeeze as price shrunk. Same thing here. And each time we're seeing, okay, a little bit more positive inclination here. And then when it breaks, that's the leading indicator for the go trend. So remember, momentum is a leading indicator. We've all done that sort of traditional technical study, and we know that momentum is a leading indicator. So as that momentum changes from being primarily below the zero line to being primarily above the zero line, that leads us then into the go trend. And now we're finding support and we're in positive territory.
And last but not least, XLRE, the real estate market.
Yeah. Is it a sector? Isn't it a sector? But the chart's fairly similar. We're in a go trend at just coming off highs. Going to watch to see what happens here when the oscillator approaches the zero line. We'll look to see if it finds support, in which case go trend likely to continue.
Now, I know we are coming up on time, but one of the most powerful concepts in technical analysis is relative strength. So we just went through all 11 sector spider ETFs to take a look under the hood of the S&P 500. What we would do at GoNoGo Charts is to look at the ratios of those sectors against the benchmark. The concept of relative strength is we want to own those things that are beating our benchmark. looking for longs and shorts based on the relative momentum of those sectors. So just as a quick example, let's take a look at the XLC versus the SPY. And in TrendSpider, it's just a simple division of the sector over the benchmark. And we can see that it's been tracking quite tightly and yet outperforming if we go back to the start of this bull market in 2023. Yep. So for all of you at home, I encourage you to take a look at ratio charts whenever you're looking at your top-down perspective. You can do this across the asset classes. You can do this sectors to a benchmark index. You can do this individual securities against either their sector, their industry group, or the broader market. That's a really powerful concept in technical analysis, and one that we use every single day. Alex, the last thing I think we wanted to touch on were just some of the thematic moves that might lead us into year end, and probably not going to be changing their trend conditions based on the presidential election. Let's hit these real quick. Pull up the ticker symbol IAI. And so when we looked at the financials sector of the markets, we know that that's a broad mix of banks and large global banks and municipal banks. This is an ETF of broker dealers and exchanges. So if you really enjoy trading and don't love paying exchange fees, this is the chart for you, because you can profit on their profitability. Broker dealers and exchanges have been in a very strong go trend. Look at the positive momentum and one test of the zero line, giving us a trend continuation. How about cloud computing, Alex? SKYY. Wow, say that 5 times fast. You're going to be in a pop song. There's a bull market, and we're not seeing that change at all. So a lot of media attention on the AI revolution, a lot of focus on the semiconductor space. But there's a lot more happening, innovative work across the marketplace. Some of these thematic ETFs really caught our attention when we were doing scanning and screening. How about one more? Cybersecurity, ticker symbol HACK, HACK. Not a bad trend, right?
Yeah, and what's interesting here is that we seem to be taking out these prior highs, right? So we failed here. But now we seem to be consolidating above those levels, and the oscillator is in positive territory, and we're seeing strong go bars. So that's a nice sign as well.
Absolutely. So, folks, that's what we wanted to walk you through today. Sectors, a top-down approach across the asset classes, and then just the basic concept of letting the evidence deliver your opinion, rather than forming your opinion and then searching for the evidence that would support that. So this election season, I'll quote a famous U.S. philosopher, Vince Vaughn: get out there, vote like a champion, and we'll see you again on the next TrendSpider conference. Thanks so much for listening.
Hey everybody, Jason Krutzky from TrendSpider here. I want to thank you all for tuning in to this very special election event. I've really enjoyed getting to see what all of the other speakers have to say about their thoughts on the election and going forward after the election. I've learned a ton. I hope that you guys have too. But let's talk about kind of what my thoughts are and what we're seeing on the platform here, shall we? I'd like to start with perhaps a bold statement. When it comes to the markets, I don't think it really matters who wins the election. Sure, some things are going to change. Some sectors are going to perform better than others. Some new leaders will emerge and some current leaders will stop leading. But at the end of the day, all it takes is a quick look back through history to see that markets don't really care all that much who the president is. When we zoom into the SPX chart, the charts that I'm flipping through here, they show percentage returns per president over the last 50 years. Despite crisis after crisis, wars, inflation, scandal, pandemics, and turmoil of all shapes and sizes, every president over the last 50 years, except for George W. Bush, bless his heart, has seen positive returns during their term. So that's great, right? Markets are likely to go up no matter who wins. The problem with that statement is that there's no real alpha in it, right? As a trader, what I really want to know is what specific areas of the market should I be focused on? And if you want to identify what areas of the market might benefit the most post-election, the only thing that I could really think to do was look at history and see what's actually happened in the past. So that's what I did. I made a watch list of all the major index, sector, and industry ETFs that I could think of, and I went through them one by one to see if I could find any trends that really stuck out. The first thing that I stumbled on was uranium. Seasonality data on the URA ETF shows us really strong performance in December of election years and the January that follows. In fact, URA offers the highest average return out of all the ETFs I analyzed during these 2 months directly following the election. So that's particularly interesting to me for one key reason: AI. We all know that the AI narrative is more powerful than it's ever been. So it's interesting to see history lining up with the current state of affairs. We also know that AI proliferation is going to require a ton of power. And you've got big tech leaders currently investing in the space. You've got Sam Altman from OpenAI. He's investing in Oklo. Bill Gates is putting his money behind a company called TerraPower. Jeff Bezos has backed General Fusion. Google is supporting TAE Technologies. Microsoft have partnered with Constellation Energy. So clearly, uranium and nuclear energy in general is going to be a key focus regardless of the administration. So then the next step is to consider the effects that each candidate might have on the space. Now, admittedly, I'm no expert in this, but if Kamala Harris is elected, I'd kind of expect her administration to continue pushing the same agenda as Biden's: clean energy, sustainability, reducing carbon emissions. These areas of focus could all presumably boost demand for uranium. A Trump administration, on the other hand, would likely prioritize energy independence, right? Bringing it home with a focus on domestic producers and supporting private sector investments. So with those agendas in the back of my mind, I think there are a few key names that we should be focused on that could benefit regardless of who wins. The first one is Constellation Energy, kind of an obvious one, but I want to start here simply because of how strong it is. It's currently outperforming 99.2% of the names in the S&P 500. Looking at the weekly chart, it's currently finding resistance at a key level, the 1.618, the golden fib extension from the previous major swing high to low. That's going to be the obvious spot to gain. And then you could use, if you wanted, additional fib extensions to gauge targets higher. If we drop down to the daily, we see what started this leg higher is a huge power gap up on volume on the news that they had signed that deal with Microsoft, a 20-year power purchasing deal where they would be reopening 3 Mile Island to provide that power. Well, when it comes to these power gaps, in the best case scenario, the gap never fills. The price just continues to drift higher. So I think the key thing to watch, at least on these low timeframes, is simply that. The way that I prefer to track it is with an anchored VWAP from the gap up. If price stays above that VWAP, then the average buyer from the gap up is in the money and is supporting the price. If the price drops below the VWAP, then that could become resistance, and perhaps it's best to wait until price is able to reclaim it to establish new long positions. Now, it's also important to note, after that news came out, we saw quite a few analysts revise their average price targets to the tune of about 19% higher. The previous average target was $226 per share, whereas now it's about $270 per share, $269. That's essentially where we're trading at now. So that's something to, kind of keep in the back of your mind. Price immediately went to the average analyst target. The second name I want to highlight is Cameco Resources. Cameco is another one in the group that's looking pretty good. On the monthly, we see it's consistently found support at its 20-period SMA since it gained it back in November of 2020. I'm also keeping a close eye on this monthly bullish MACD cross. You're going to want to see them stick the landing here with that, really continue pushing momentum in the direction of the bulls. Fundamental performance has been solid. Revenue numbers have been increasing pretty steadily over the past few years. Back when price really gained that 20 SMA on the monthly, you see a clear relationship between revenue ticking up and the price moving higher. So I think you want to see that relationship continue. Also, seasonality trends support strength into the year's end, with November and December of election years historically bringing in high win rates and notable average returns, 7.65% and 8.7% respectively. So there's a convergence there between the ETF and the individual name. So now I've got an idea of the sector of the market that I want to be focused on directly after the election. But what about the first year of the new presidential term? The next idea that I had was to see if I could identify any trends in the year that follows an election. And in fact, I found a few. The first one was in home builders, the XHB ETF. And what I found was that in the year following an election year, home builders offer the most instances of monthly outperformance compared to all of the other assets that I analyzed. They have the highest average returns of any sector, specifically in 3 key months, in March, April, and July. Now, this is interesting to me for another key reason. Another thing that's obviously been top of mind for all of us traders are interest rates. Powell and the Fed just cut by 50 bips. The expectation is that they're going to continue to slowly cut over the next year or two. If they do stay on that path of cuts, then we got to expect that mortgage rates are going to slowly decline, which means an increased interest from new home buyers. The housing market has mostly been in a standstill lately. This could free it up. So now again, I'm no expert in policy, but generally speaking, I'd expect Kamala to be more focused on things like affordable housing, urban redevelopment, green construction, whereas Trump, I think, is going to be more focused on deregulation, which I have to assume would lead to reduced costs for developers. Maybe we can build more houses more quickly. So I think home builders definitely benefit no matter who gets elected. And there are a lot of great looking names in the space. You got Home Depot and Lowe's, both looking awesome here, pushing into new all-time highs. Lowe's is leading slightly. You've got home builders like D.R. Horton, Toll Brothers, and Meritage. They're all in these Weinstein stage 2 extensions higher. Lots of really good looks out here, but I want to look at 2 specific names. The first one is Lennar. Lennar is one of the largest home builders in the US, and with their focus on sustainable housing solutions, they're definitely going to benefit from any government subsidies that get distributed for low-income housing projects. So Lennar Corporation has really been on a tear for the past 2 years. It's currently outperforming 81.5% of its sector peers. It's consistently found support within that monthly 821 EMA cloud. Its name has managed to recently gain the 200% Fibonacci extension from the 2022 high to lows. So to me, that is a key risk on or off level. Above 172, we want to be long. Below 172, we want to have a little bit of caution. Also, in late September, Lennar saw a wave of analyst activity, mostly buy or hold ratings, and post-election year seasonality trends point to March as the highest average return month for the name with a 6.83% average gain. So it's kind of confirming what we saw in that ETF seasonality as well. The second name that I want to highlight is slightly outside of the realm of the home builders. It's not actually a home builder name, but it's absolutely necessary to the process of home building, and that's Caterpillar. Now, Caterpillar has shown unbelievable strength this year. It pushed powerfully out of the long-term ascending wedge in February. It retested that breakout spot in August. It's making new all-time highs this month. However, 2 quarters of revenue misses in a row, as well as the expectation of EPS numbers to to decrease over the next 2 quarters could be providing a bit of a warning shot for bulls, at least in the near term. To add to that, relative performance is showing a clear negative divergence, with the stock weakening relative to the S&P 500 with each new high that it's made since 2023. When it comes to relative performance, you really want to see new highs in price correlating with new highs in RP. So this could be a sign that the name is actually weakening a little bit under the hood. We've also seen majority selling from government officials throughout this year's run-up. So these are all things to keep in the back of your mind when considering long positions on the name right now. But all that said, however, if the strength does continue into next year, the highest potential for positive returns in a post-election year on Caterpillar come in the early summer months of April and May. Now, going back to that bigger scale seasonality analysis that I was doing, when I focus specifically on sectors that offer just the highest win rates following or in the year that follows an election, I found that the most consistent performance was in 2 sectors: aerospace and defense and semiconductors. So let's talk about aerospace and defense first. The aerospace and defense sector, represented by the XAR ETF, shows strong post-election performance with a 100% win rate in 6 out of 12 months in the year following an election. Now, of course, defense is going to be super important under either administration. Under Trump, the defense budget reached $740 billion by fiscal year 2021. Under Biden, it ballooned to $850 billion by this year. So there's a lot of unrest out there these days. I can only imagine that these numbers are going to continue to grow under the next administration, no matter who is in charge. So let's look at a few key names. The first one that I want to highlight is a name that I don't personally hear discussed too often: Howmet Aerospace. Now, if you follow us here at TrendSpider, if you follow us closely, you know that we recently released a scanner that identifies CanSlim names. And this name, Howmet, happened to come up in that scan. It's got 10 straight quarters of year-over-year earnings growth. It's outperforming 99% of the S&P 500. This one is a monster, and analysts really seem to like it too. You've got a top target estimate of $125 from Deutsche Bank. On the other side of the coin, you've got a name like Boeing, who's really facing some challenging technicals. It recently broke below its 200-month SMA. It's now testing the ascending trend line from the COVID low. If this area fails, there's a large volume gap below that could act as a magnet for price. So we got to keep a really close eye on it. It's currently underperforming nearly all of the names in the S&P 500, and analysts are absolutely reacting as you would expect them to. All recent price targets have been revised down. However, if you're looking for a potentially bright spot post-election on Boeing here, the highest win rate and average return historically comes in May. The last name that I want to highlight in this sector is Lockheed Martin. For this one, bullish MACD crosses on the monthly seem to be the name of the game. They offer up big gains each time they've occurred over the last 5 years. So it's no wonder that we've been seeing so much buying from government officials over that same period of time. Now, Lockheed's recent period of strength has pushed its relative performance score to over 90, meaning it's outperforming all but about 10% of the names in the S&P 500. And if you're curious how this strength might fare post-election, we find that May offers the best opportunity for gains with a 100% win rate and an impressive 5.5% average return. Beyond the technicals, also, Lockheed continues to reward their shareholders. They recently raised their dividend by 5%. That marks 22 years of consecutive increases. So last but not least, let's talk about the semis. We see the exact same performance from the SOX ETF as we did with XAR. 6 out of 12 months in the year following an election have 100% win rates. Semis are critical for AI development, 5G technology, automobiles, modern defense systems. This sector is going to be a pivotal one regardless of administration. Under a Harris administration, we have to assume the semiconductor industry would likely benefit from support for sustainable technology and initiatives in AI, clean energy, 5G. Maybe we would see government incentives to advance these areas. In contrast, a Trump administration would likely emphasize domestic manufacturing and reducing dependence on foreign production. He would also likely provide tax breaks and regulatory easing to bolster US-based semiconductor facilities. So, green tech and innovation under Harris versus manufacturing independence under Trump. Let's talk through two key names. The first one, obviously, NVIDIA. After several months of consolidating and price filling the fair value gap created in May, NVIDIA appears to be starting its next leg higher, if you can believe that. You could see it's attempting to gain the 500% Fibonacci extension from its 2022 high to low. Unbelievable performance. Its relative performance score is nearly unmatched. It's outperforming 99.4% of the names in the S&P 500. And despite massive selling of over $700 million in shares from CEO Jensen Huang, analysts are as bullish as ever. Recent buy targets average $154 a share. Seasonally, if you're curious about that, NVIDIA's strongest month in the year following an election is May. It gives us an 86% win rate and an average return of 19.71%. Crazy. Last name I want to talk about here is Intel. It's been a tough road for Intel bulls, undoubtedly, but the stock is trying to dig in exactly where it has over its many years at the anchored VWAP from its 1986 IPO. On the monthly, it's also showing a clear bullish RSI divergence in what appears to be a volume climax right at the lows. This is typical of what's seen at major tops and bottoms. In a show of confidence, you've got Intel's CEO, Patrick Gelsinger. He's also made some purchases this year. You don't see CEOs buying all the time. So when you do, it's worth it to kind of keep it. It's worth it to be mindful of it. So that signals that leadership is seeing potential value at these levels. The last little piece here, seasonality in the year after an election. It might take a little patience for seasonality to play out. The month with the highest potential for positive returns happens to be December. So maybe don't jump right into long positions on Intel, but keep your eyes on it. So as we've explored today, while the future remains uncertain, history has shown us that patterns do often emerge after elections. By analyzing these presidential cycles, seasonal trends, and sector-specific insights, we've identified areas of the market that could present significant opportunities based on the election's outcome. So by looking at the past, we've kind of positioned ourselves to capitalize on what could lie ahead. Now, some of these ideas might work. Some might not. We could get some huge surprise in the coming months that no one is expecting. So I do think that what's most important going forward is to have the right tools and keep an open mind. While I can't personally help you with keeping an open mind, what I can do is I can offer you a tool. Earlier, I mentioned CanSlim when we were talking about HowMat. And now I want to share that CanSlim scanner with you guys. If you're not already familiar, the CanSlim methodology was developed by legendary investor William J. O'Neill. He used the philosophy to identify stocks with explosive growth potential. And this scanner takes into account his requirements and finds stocks meeting that criteria right now. So as we move forward into this next phase of the market, don't just sit on the sidelines. With TrendSpider, you can take advantage of this CanSlim scan and all of the tools that I utilized in today's presentation to position yourself for success and capitalize on the best opportunities that emerge post-election. So with that, we're going to wrap it up here. I want to thank everybody for tuning in. I also want to give a very special thanks to all of our guests for so graciously giving us their time. If you liked what you saw today, you're interested in giving TrendSpider a try, we've got a great deal that we're offering this weekend only, and I'm about to sign off. So as I always say, happy trading, and we'll catch you guys next time.